Good morning, everybody. How's everybody doing today? Yes. 大家好，欢迎来参加 HashKey Capital 在此次 Web3 嘉年华的主会场。Good morning, everybody. Welcome to the HashKey Capital event at the Web3 Festival. Build and invest in a compliant future for Web3. 我是今天上午活动的主持人Michael. I'm the moderator for this morning's event, Michael. Just a couple of housekeeping items. Number one, if you require simultaneous translation, you can scan the QR code at the entrance. Second, this morning's event is broadcast live on YouTube and also on Live Hall. If you want to send the link to your friends who couldn't make it here, the link is also on the same Eventbrite registration page. And last but not least, you have a gift bag on your seat. Feel free to take that with you if you leave, but don't leave too early. And you'll find the mobile charger in there particularly interesting. 就简单说了几件事情。第一呢，如果大家需要同声传译的话，可以在门口扫一个二维码，有同声传译。第二呢，今天上午的活动也是有现场直播，在 YouTube 和 Live Hall。最后呢，我们精心为大家准备了一个小礼品袋，就放在大家的这个座位上。里面可能这个充电器可能在今天会格外有用。Okay, we'll get the event started. I think we all love Web3. We love the technology stack. We love the sense of community. But also we recognize that for this to prosper, we need to build and to invest in a responsible fashion. I think that's the theme for today's event. So first, I would like to invite Mr. Deng Chao, DC, CEO of HashKey Capital, CEO of HashKey Group Singapore, to come on stage and deliver the welcoming remark. 首先，我邀请邓超先生 ，HashKey Capital 的首席执行官 ，HashKey 集团新加坡首席执行官上台致开幕致辞。DC。
Can you hear me? Good morning, everyone. Thank you very much for getting up so early. I know every one of you have like tons of events, drinking, social. Some of them may last very late or very early in the morning. So I hope to thank everyone for coming and joining. Today's topic is about how we can we build and invest in the Web3 in a compliant and responsible way. We are fortunate to invite investors, founders, entrepreneurs, and all stakeholders in the entire ecosystem to join us. Also, I would like to take this opportunity to share a little bit about our journey of building a compliant business. I will use 3 keywords to summarize what we have experienced and what we look forward to. The past, present, and future. We started our HashKey investment business actually in 2017, but we launched our first fund in 2018. I hope to share a little bit story how we and why we spent a year just to prepare one fund. That's because at that time there was no sense, no infrastructure, there was no rule to follow. I spent more than half a year to talk with auditors, fund administrators, and lawyers to get them involved in the formation of our new fund. Every one of you, some one of you may have been through that. But fortunately, coming to nowadays, to the present, we're happy to see a lot of professionals, a lot of experienced entrepreneurs, builders, investors coming in. And we're also happy to see that the regulators, the government, in each jurisdiction, in many jurisdictions, are coming out with more clearer regulatory frameworks. And we have more legal professionals, more fund administrators, auditors to come and join us. And very importantly, we're seeing builders, investors are bringing their business into a more mainstream or institution grade level. looking to the future, I think what was once the Wild West, as we call the crypto in the early days, will become the Silicon Valley of nowadays. It will be the hub and the forefront of entrepreneurship and innovation. And we also believe that the technology, the blockchain technology, will generate the next generation of Google, Facebook, Alibaba, and Tencent. And we also believe that the digital economy, the Web3 economy, will bring more financial inclusion and benefit billions of users. Finally, please allow me to introduce two of my colleagues. And we just announced our management led by our MC today, Michael. I will give the floor to them, but you only have 30 seconds to finish your presentation.
Thank you, DC. Good morning, everyone. Our OTC desk, we will upgrade our services to strengthen our offering in off-ramp and also spot block trading. We would like to extend our service to 24/7, and also we will continue to add more tokens to our OTC offering. Thank you.
Michael?
Yeah, and I think second half this year we'll launch HashKey Wealth, a new business unit within HashKey Group, and we want to bring a comprehensive solutions to both traditional investors who are getting into Web3 for the first time, or crypto-native Web3 users as well, in a simple, secure, and regulated fashion. So please look out on more further announcements from HashKey Wealth.
Thank you both. Thank you, everyone. Let's build, invest, and benefit together. Thank you very much. We look forward to the sharing today. The floor is back to Michael.
Thank you, DC. That's another warm round of applause for DC. Thank you. Okay, let's get to the first amazing panel today. I'd like to just warmly invite my friend and friend of HashKey and the moderator for the first panel, Patrick Chan, founding managing partner for Substage Capital, to be on the stage, and Patrick will introduce the rest of the panelists. 大家好，我们现在开始我们今天上午第一个圆桌会议。这是顶级全球Web3 VC， 他们如何看 Web3 的投资机会？我先邀请 Patrick Chan， founder 创始人Substage Capital 是今天圆桌会议的主持人。Patrick, the floor is yours.
Well, good morning, everyone. Thanks again for coming. We're super excited about this panel today. Thanks again, HashKey, for having us. This panel is going to be about VC perspectives on Web3 investments. We're going to cover a bunch of topics, a lot of stuff on everyone's mind from regulatory standpoint, what's happening in the US, what's happening globally. And then also looking into the future on what Web3 is going to be all about. I'm super excited for this panel, and you guys should be too. This panel is amazingly stacked with some amazing talent. Everyone here has kind of seen multiple cycles of Web3, and they probably have seen almost everything that's kind of happened. So I will introduce, I'll have everyone introduce themselves. I'm going to throw a quick curveball at you guys. I want, one question. One answer is, how do you guys differentiate yourselves from your peers on this stage? But I'll start first. I'm your moderator, Patrick. I'm founding and managing partner of Substage Capital. Quickly is we're a pre-seed seed fund, primarily exclusively focused on Web3 infrastructure. I've been investing in the space since 2014. And I would say our differentiation is we come from a very traditional enterprise infrastructure. So we kind of see things more from a Web 2 perspective, but applying it for Web 3. We'll go down the line. Adam?
Hi, Adam Winnick from Los Angeles, California. Thank you, HashKey, for having us here. My fund, Finality, is focused on infrastructure, decentralized infrastructure primarily. We'll share our investment thesis as the panel goes on. I would say the biggest differentiator, based on what I know about these other managers up here, is we're a first-time fund.
Yeah. My name is Alex. I'm from New York. I'm the co-founder and managing partner of Hack VC. We're an early stage, mostly infrastructure as well as DeFi focused crypto fund. And yeah, we try to be very technical and technology focused in everything we do. We're users of the protocols ourselves. We have a whole lab division. We do DeFi participation. We do staking, things like that. And we run our own summit as well, like conference series as well. And series of hackathons. It's called the Hack Summit. It's a 100,000+ community of blockchain developers and engineers. Very different from this conference, more like only CTOs, very technical, things like that. Just trying to support the ecosystem and community. We've been doing it for about 10 years, so.
Hi, I'm Seth Gins from CoinFund and from New York. We're a crypto fund family. We have pre-seed seed funds. We're on our 4th fund, Series A fund, and then a liquid fund. We also take a very technical approach to the space. I'd say one of the core differentiators of CoinFund is that our background is TradFi melded with very crypto native. So my background is 18 years of public equities investing, large cap growth investing, but I also got involved with crypto in 2012 by being an early investor in Coinbase. Many of my other managing partners at the firm came from traditional venture like Venrock, traditional sell-side finance like Citigroup, and then we also have people like my founder, Jake Brookman, Alex Felix, our CIO, who have been in the space full-time for almost a decade now.
Hi, everyone. My name is Ophelia Gao. Maybe I'm the only one in this panel that come from CFI, the traditional financial institution. Now I'm the CEO of First Friend Holding Limited. And prior to this company, I worked in one of the largest mutual funds in China, China Merchants Fund. So maybe the label of myself is just from CFI or not so decentralized. But with the more regulated or the revolution of this Web3, maybe we will add more crypto assets to our portfolio. So I came here just to communicate with the other guys and learn from you, maybe share my experience in the traditional fund investment.
Awesome. Well, yeah, thank you guys for the intro. Like I said, such amazing experiences across the board here. So yeah, let's kick off the conversation. So first off, let's talk about regulation, like everything that's kind of been happening recently from on the U.S. Regulatory side, from SEC crackdowns, the global shift in regulation in different markets as well. What do you guys kind of see from an implication standpoint on how does this affect investing in early stage investments? Maybe I'll start with Ophelia and Alex too. Ophelia, since you operate in a very traditional financial sector in CFI, everything you invest in or look at is touched on by regulators. And Alex, maybe you can follow up after that. Is from an early stage ventures perspective, how does that impact your outlook as well?
Okay. I think DeFi, as long as I see, is just decentralized financial services. Maybe it's more transparent and more efficient compared to the CFI. CFI is centralized, and we need intermediaries to act as a centralized hub to service our clients. So I think both DeFi and the CFI has its role in the present market. I think in the future maybe DeFi and the CFI will integrate together because our CeFi service will also adopt the blockchain technologies, and some DeFi, service also need some regulated institution to provide the client protection. So maybe in future, both these two approaches will coexist, and we will learn and converge with each other.
Yeah. I think regulation is very important eventually, but I think it's actually not that meaningful in the early stages, because any early stage technology company, especially in crypto, is doing something totally new and novel. And so it always has to, there's always some level of regulatory grayness and ambiguity when you're doing something so new. You never know, and the regulators don't really know either how they're going to deal with what you're building, and they sort of wait for a few years. So I remember I used to spend a lot of time in Hong Kong and Asia before the pandemic. I helped co-found, and I was the first investment partner at a great crypto fund in Asia called Dragonfly. And we were fundraising in 2018, and primarily from very famous like technology investors and founders of massive Chinese and Asia technology companies. And the number one reason many of them were skeptical or maybe didn't invest in us was because of regulatory questions, like, oh, who knows how it'll play out. Since then, and many of them, instead, their biggest holdings were, like Alibaba, Tencent, and, large cap Chinese tech stocks, right? And so since then, Bitcoin and Ethereum are up like 5 or 10x, and many of the largest Chinese tech stocks are down, over in half because of regulatory reasons, which nobody expected at the time. Nobody thought in 2018 that this would happen. And so regular risk can play out in very surprising ways, and in many ways, crypto is quite anti-fragile to regulatory questions because of how new it is.
And I was wondering, so I mean, what do you guys think though with like the recent SEC kind of crackdown? Is it something that has like staying power, or is it more speculative kind of play, or is it political theater? I don't know, Seth, given that you have a lot of impact on like liquid market side, I'm sure you're following a lot of the shifts.
Yeah, I mean, I'm very much with Alex with the view that regulation is important. Regulation, having a clear regulatory framework on a global basis, increases the addressable market of the space. So when we have clear regulation, we've de-risked the space, and the opportunity becomes much larger. The way I think about what's happening right now with the SEC, and then we also have it happening with the bank regulators, so with the Fed, with the FDIC, with the OCC, it is an attempt by regulators to start to define the regulatory environment in the absence of legislation when we have a Congress that's divided right now in the US, and that's fine. We'd like to maybe see it done in a little bit of a different way as an industry, but the reality is there are lots of crypto supporters in DC. Every action has a reaction, so the more aggressive the SEC or the bank regulators or the CFTC become, you start to have the House Financial Services Committee become more vocal. Chairman McHenry, Tom Emmer, French Hill, as Republicans, also a lot of Democrats who are supportive of crypto. So we're getting the dialogue going. That's very different from where we were as an industry 3 years ago, 4 years ago. There was no Washington, D.C. dialogue. And when you think about what's actually happening, this is the messy part of defining the regulatory environment. But 2 years from now, we'll have that regulatory environment. We'll have an operating environment that's viable, and that de-risks the space. The other thing that I'll add is when you look outside of the US, and crypto is global, as we're sitting here in Hong Kong is taking very big steps to open to crypto. That's incredibly important. That's recognized on a global scale. That's why a lot of us have come halfway around the world to be here to kind of get the pulse in real time. You look at the UAE, same thing. You look at Singapore, same thing. You look at Europe with MiCA, actually having a regulatory framework, legislative regulatory framework. That's very healthy. The UK, also starting to define regulations. So crypto is global. We have a lot of jurisdictions that are very open to crypto, moving quickly to define a viable operating regime. And in the US, we're walking down that road. It might look a little messy. There might be some scary headlines, but this is the path we need to take to have that regulatory clarity in a few years. So I'm very, very excited to see that progress.
Awesome. Yeah, and I think with the kind of clarity that kind of happens with the regulation, we can actually have the builders focus on building without having to worry about like these overhangs that happen. And I guess that kind of transitions us to what is getting built today, and in order for Web3 technology to become mainstream, we really have to think about what are the future killer applications that are going to come about. And there's so much being built, and what kind of toolings, what kind of things that are happening right now that enable these developers to build. I know, Adam, you have this deep thesis around application development. Like, what are you seeing, and what are you most excited about today for these future builders?
Yeah, thanks, Patrick. So I run a conference called Medici, and we bring a lot of institutions, the leading the CIOs, the portfolio managers of large hedge funds, pension funds, endowments, and sovereign wealth funds. And when crypto was at its height, everyone was excited. People didn't ask tough questions. After Luna, after Three Arrows, Celsius, even before FTX, the number one thing I heard from people was,
listed every one of them. Huh? You just listed every one of them, but it's okay.
Well, I'm just saying. I mean, like these are the key milestones. Let's just call it the after last summer. How about that? Is that better?
Yeah.
Okay. After last summer, what I heard from people was this: Adam, I think blockchain is interesting. I just don't see the utility of it. When am I going to use these applications? There's a lot of articles. When are in '95 there was email. What does blockchain give us other than speculative tokens? And I struggle with that question. I looked for lots of answers, and I sort of settled on, as I did my research, I came across a very interesting statistic. The average Web 2 SaaS application integrates with 15 other applications. Great applications are supported by other applications. Does anyone want to take a guess of the number of integrations that a typical Web 3 application has? The number is about 3. Okay? So if you want Web 3 applications that have a lot of utility, that surpass the utility of Web 2 applications, we're watching that number to go from 3 to 15 or 20. But Web 3 applications have an additional burden. All the applications that integrate with each other need to be decentralized. They need their own trust networks. And if they're going to match the same trust network of Ethereum, then every one of those applications needs to have $30 billion at stake and pay a significant amount of, protocols need to pay a significant amount of security or staking rewards to validators for security. We've estimated that number, if you want 15 applications, to be $440 billion at stake, and for protocols to pay $40 billion a year in security costs. That is a huge obstacle to delivering the utility that everyone is talking about. So we think the great applications we're looking for are a few years away. But it's not that long. It's actually sooner than you think, because now that Ethereum is proof of stake, you can do something that's been developed on other applications like Avalanche, that's on Polkadot. It's called shared security. It's leveraging the trust network of Ethereum to support other applications. And we can talk more about what shared security means. But there's a company called Eigenlayer that Alex is an investor in that is allowing for new blockchains to pay for security to validators on Ethereum. And the average cost of security for a new blockchain is around 9%. It's double what Ethereum has to pay its validators, because it's riskier. But if I'm a validator on Ethereum and I have my stake, I don't need 9% from 10 different blockchains if I'm using the same collateral. I maybe only need 1% or 2%. So that lowers the cost of security for all these new blockchains. And if you do that, you're going to have an explosion of middleware services, Oracle services, new file storage services, new identity services, new off-chain computation services. You're going to be able to have all those things, and you're going to be able to integrate those things and abstract away complexity for application developers to integrate 15 different applications to make applications that people want. And then you're going to have the kind of applications that we've all been talking about. Networks, applications owned and operated by users, where we have the same ownership rights and governance rights that we do in the physical world. And that is our vision. Proof of stake is here on Ethereum. Shared security is less than a year away on Ethereum. And application developers are starting to build on these shared security services to give us the applications that we want. So I can't tell you all the applications that are going to exist, but I can tell you that they're about 18 months away.
Yeah, and Alex, you've been in this. We've been in this for 3 cycles already. You've kind of seen all the waves that kind of happen. You caught them from like the DeFi stuff, various different infrastructures. So tell us, like, what do you think is going to happen in this next wave? What are you most excited about?
Yeah, I think the right way to think about crypto is it's this big technological paradigm shift. And these paradigm shifts, if you look at prior ones like the internet in the 90s and 2000s, even older ones like railroads and so forth 100 years ago, they come in these waves and cycles that are quite common. The current one in crypto is it can go up and down a lot. I mean, there's a lot of aspects. It's all digital. The tokens lead to liquidity, which lead to volatility. But there's always cycles anytime you have this massive technology shift. And there's cycles of infrastructure development, applications that build on the infrastructure, and then they sort of call for new pieces of infrastructure. So you see this cycle over the last 10 years of crypto where, for basically, I guess actually crypto's 14 years old, right, since 2009. And so for the first half of it, for 7 years, there was only one use case that anyone actually did anything with, which was Bitcoin, which was just like buy and hold your little store of value, your digital gold. And then that was all you could do on the Bitcoin blockchain. Like Bitcoin was both application and infrastructure all in one. And yeah, you couldn't do anything else, right? And then you had to have Ethereum, and then there was all this excitement about Ethereum, but you couldn't really do anything on Ethereum. It just sort of increased the possibility space. Like it made people imagine more things you can do. But then it took a few years to build, and then you had DeFi and NFTs, which CoinFund was very early in as well. And these cycles perpetuate over and over. And I think we're still if you think about what Adam said, it can be a little confusing. The very high level is there's just so much more middleware that needs to get built. We're at the very, very bottom layer that's been built. Ethereum finally pulled off 2.0. It was a huge achievement. Took 10 years, and now we have all this middleware, Oracle solutions, shared security solutions that are sort of required for the next phase. The real comparison, in many ways, I think we're in the early 90s, really, with where we are in the cycle. And the reason I think that is because, if you think about the early 90s, when I remember back to the early 90s, when I was 1, 2 years old and I was using the internet, maybe you could actually give the feedback, not to put you on blast, but basically the only people using the internet in the 90s, before AOL, before Yahoo, before Baidu, before Google Search, before any of this stuff, before even web browsers, were people that were really committed to it for ideological reasons. They saw the future. There wasn't much they could do back then, but they thought it was interesting. Or people that are really technical, because everybody was constantly just getting hacked in the 90s. And there were viruses everywhere. We're in a basically similar space here. We don't have as much security as we need. Everyone is getting hacked. Everyone's getting scammed. It didn't really make much sense for the average person to use the internet in the 90s, similar to where we are in blockchain today.
Super interesting. And then what's really interesting is too, the one thing so far that's kind of proven to be the killer app has been really cryptocurrencies, like you were kind of mentioning, and that kind of goes back to exchanges. That's still the only real killer application. Everything else like NFTs is emerging applications. I guess Ophelia, like what do you think from a CFI perspective, financial perspective? Like what are like some of the most exciting things you're looking forward towards?
Actually, I think CFI, when we as VC of CFI, maybe we raise money from the traditional investors. We raising money, we investment, we manage, and then we exit. We exit by listed the company during the exchange, the traditional exchange. But I think during the DeFi world, if we invest as a VC, we invest in those entrepreneurs and projects, maybe we can exist by token. So maybe this is the difference between these two approaches. If the shares in the capital markets have good liquidity, then we can cash out. We can really get the money back. But I think now the token during the DeFi world or the crypto world maybe have more liquidity. Some of the tokens have more liquidity than the normal shares in the traditional world. So maybe that's the difference, or that bring the crypto world to the mainstream.
Yeah.
Yeah.
I completely agree. And what's super interesting too is like, when you talk about, building, especially these early stages, then we always have to talk about like valuation, right? We're now valuations, you would think that we're currently in this quote unquote bear market, we're far away from, the bull market that kind of happened in 2021 and slowly came down in 2022. But the crazy thing is, and I'm sure you guys have seen on the private side, is valuations kind of have stayed a little elevated, right? And maybe like a lot of you guys are wondering, like, why is this? But Seth, since you're a liquid token investor, you're really always thinking about like the market. What are your thoughts here? Like, especially with all the negative macro overhang, somehow BTC ETH is been on a tear recently. What are your thoughts there, and what are the implications on it on the private side?
Yeah, so there are a few things. I'll touch on the last question quickly as well around use cases for crypto, because I think we did a webinar recently, and we pulled data from January of 2020 to December of 22, just looking at the growth of the space, and the secular growth is extraordinary. So all of the metrics that we were looking at, whether it was developer activity, so monthly active developers for the overall crypto ecosystem, whether it was centralized exchange activity, so trading volume on global centralized exchanges from January of 20 to December of 22, whether it was on-chain Ethereum activity, derivatives activity, DeFi activity, going one thing after another, NFT activity, trading volume in dollars and number of transactions, one after another, you saw a huge increase from January of 20 to December of 22, even though the December of 22 number was down significantly from the peak of the prior bull market. So just an astounding showing of secular growth. The other really interesting data points, institutional trading volume. So looking at Coinbase's institutional trading volume, massive secular growth, over a 5x increase over that time period, even though it was down materially from the peak in 21. And then I think one of the core use cases that we talk about a lot is stablecoins. So these are mostly dollar-denominated stablecoins. And I'll be a little off on these numbers, but stablecoins outstanding at the end of 22 was about $140 billion. Beginning of 20, it was $2 billion. That's secular growth. Stablecoin transaction volume, 26 billion at the beginning of 2020, 650 billion, and that was actually near the all-time high at the end of 22, for December of 22. This is secular growth, and you kind of like, as Alex was pointing out, there's a lot of volatility, but you step back from that volatility and there's massive secular growth over the last 3 years. When we think about valuations, so valuations have remained elevated, but they have come down in the private markets. In the liquid markets, valuations have actually remained relatively steady. It varies across different protocols, but you could say valuations have remained steady. And by valuations, I mean multiples. So on-chain activity has come down a lot, and then the multiples in many cases have remained relatively stable. But I think it's really important to talk about what I mean by multiples, because my background is traditional equities investing. And in traditional equities investing, you're using PE multiples, so price to earnings. You're using EV to EBITDA. Sometimes you're using revenue multiples. And lo and behold, in crypto, it's the same thing, right? So in crypto, it rhymes. So you have fees that are generated from protocols, and you put a multiple on that. You have total value locked, so the amount of collateral that's being used within an ecosystem. It's a very imperfect metric, but people look at the multiples of total value locked. It's a little bit like looking at book value for a bank, not quite. But again, you're mapping these traditional, like nothing's new under the sun, you're mapping these traditional fundamental valuation metrics from the traditional equities world now into crypto. And then Patrick, when you're asking about the market view and why I think valuations have remained at a healthy level, I think we're going to see a new all-time high for Bitcoin before year end. And I think you're going to see a lot of other tokens outperform Bitcoin over that period. And the reason I say that, and I'll just very quickly touch on this, I think 2023 is analogous to both 2019 and 2020. 2019 was the year that we were coming out of the last bear market. And what's interesting is you've historically seen a 300% move in Bitcoin roughly in the year coming out of the bear market over 6 to 12 months. What's interesting about 2019 is there was a lot of tech that was being worked on that had been funded, a lot of new developers that had come in the space in 2017, 2018, but that tech wasn't maturing for many years. It wasn't maturing until 2020, 2021, 2022. This year in there we go. This year in 2023, we have a lot of technology that's maturing this year. It's maturing in the recovery year. That's a material difference. And we've talked about a bunch of the areas that are maturing. The second analogous year is 2020, and that's analogous from a macro perspective, just taking it at a very high level. All of last year, real interest rates, real yields globally, so that's nominal yields minus inflation, they were going up. And that was a very difficult year for crypto, for tech stocks, for a lot of different risk assets. This year, real yields are coming down aggressively, particularly after the bank failures in the US. You have a lot of stimulus coming into the economy, real yields are coming down. That looks a lot like 2020 after the COVID stimulus. So you have real yields coming down, you have central bank liquidity going up. So there are a lot of things from a macro perspective that look very similar to 2020, and 2020 was a very good year for crypto.
So I guess everyone heard it first here that Bitcoin's going to be at all-time high by the year end. Is that a price prediction?
High probability bet, I would say.
At least it's a little better than Balaji's $1 million Bitcoin.
Yeah.
But Alex and Adams, given that you guys are early stage investors, what are your thoughts though on valuations at the early stages? Just briefly.
Look, I think that valuation, one thing we have to talk about is TAM, right? Total addressable market. I mean, things like the bank failure, may hurt the call it serviceable addressable market in the short term, but they're good for the TAM in the long term. So the market opportunity is still there, right? And so it's investing in early stage companies is very asymmetric. Like all you can lose is what you put up in small dollars. The upside, is very high. And people have heard me talk about the story. I asked a mentor of mine who's a VC why he didn't invest in Google, and he said the valuation was ridiculous at the time. It was 70 million pre-money valuation. So, you regret those decisions. I think, we invested in an early stage company that was a very large valuation, like 9 figures. We built a conservative valuation model around it, but at the end of the day, we think that like the white space it opens up is gigantic, and you can't really put a cap on what that means. So I think for me, it's more about this is an opportunity where we get to ask good questions. It's less about the price and more about, we finally get to ask real questions, level set with the team, build a strong understanding of how we're going to work together, support each other, and invest more money than we could before in companies. And if we have to pay a little bit up for that, we're okay. Because we have a long-term view, and we're not just trying to invest. Like I joke around that like we don't want to have any 100Xs in our portfolio. If I have 100X, it means I didn't keep investing in the company as it grew, and I didn't have conviction.
Yeah. I actually think valuations have come down a lot at early. They're basically what they were like in 2019 or early 20. And on the one hand, there's more competition. On the other hand, the TAM. To Seth's point, the TAMs.
Closer.
TAM as in the market sizes, the potential use case size, the secular growth has gone up, massively during this time. So we find it quite exciting, actually.
And I feel like I have to ask this question, given that we're in Hong Kong right now, blockchain's global these days. What is your outlook on Asian builders? Like, what kind of projects do you guys think are going to come out of this market? And then, do you guys see yourselves investing in the Asian market, across the board?
Yeah, I spent a lot of time. We invested in a lot of the early CeFi leaders in Asia, exchanges like BUIDL or CoinDCX in India and Pintu in Indonesia, trading and brokerage firms like Amber Group, Matrixport. Great companies. We love them, but it actually, I do think the phase that we're in now is very infrastructure and middleware focused. And actually, one of my theses is like, if we could back a totally decentralized version of like my old portfolio from 5 years ago, like that's amazing. Like, because the use cases have been proved out in a centralized way, but can we make it more transparent? Can we make it more permissionless, more composable? And that actually, that solves many of the problems of CeFi of the last year or two with all the lending blowups and FTX, is that they just were too opaque, and they need a DeFi. A DeFi version would make all the problems better, like across the board. So we love investing in like the radically decentralized versions of some of these successes. And Asia, many founders in Asia are amazing. They work nonstop, but they tend to be a little bit better at the application phase, which we may be still a little early for. So things like NFTs and gaming, it's not quite our focus as a fund. I think it might take a few more years for that to mature, but it takes years to build too, right? So maybe still good time to do investing anyway.
If I can just jump on that point, I mean, I see two real advantages that Asia has. One is the exchange ecosystem here. Almost every exchange I meet, or any Chinese company that's in crypto, has a wallet company they're involved with. I think the relationship they have with the end user is just a gold mine that is going to play out, and the exchanges make enough money that they can maintain the infrastructure and build before the monetization comes through the business. I mean, look, MetaMask has 56%, something like that, market share, but it's not tied to an exchange that makes like a ton of money. All these exchanges that make money, they have these wallet infrastructures they can support, build out user journeys that make sense to the user. And when the application layer is ready, as Alex has talked about, as I've talked about with this statistic of like Web3 to Web2 integration parity, they're just going to be really well positioned to help users figure out which applications to use. The other side of it is, look, the Chinese Web 2 tech market has become very mature. It's become very tied to the regulatory environment in China. There's some real talent there that has built out amazing companies, and as they look to like where they're going to spend their time and develop their entrepreneurial talents, you know, some of these people are pretty wealthy. They can leave. They can start thinking to build out 2, 3, 4 years down the line. You know, we met with an ex-Alibaba exec the other day who's building something really exciting in the space. We think it's a big play that could disrupt online advertising. It's going to take time to play out. But you know, he's the kind of guy that can raise money to keep the business alive, keep it going for 5 years from now. And again, you know, yeah, a lot of funds are looking for like, oh, let me get marked up in a year and a half, 2 years. But you know, my view is like 5 year out. I don't underwrite to 2 to 3 years. I underwrite to 5 to 10. So I just think getting more people from the traditional worlds, Tencents, Alibabas, Baidu's, into Web3 in Asia is going to be another great thing. We would love to back people like that.
Yeah, I mean, there's so many amazing insights today. You know, the time's kind of you know, coming to a close, and I want to kind of, you know, leave some thoughts for a lot of these you know, builders out there. You know, maybe for each of you guys, you know, what kind of advice do you have for people building in this space today? You know, what are some of the things that they could do to kind of attract VC's attention, such as yourself? And what can they build too, or what should they look out for, given that, you know, you guys have seen multiple different cycles? You know, how can they navigate this current environment? Yeah, how about we start with you, Ophelia, and then we'll work down this way.
Okay. Actually, I'm you know, from the traditional financial institution. So what I look maybe regulated entities and those who provide services to those regulated entities, because the appetite of our investors are more comfortable for the regulation. So maybe we will be a little more conservative. So look those like HashKey, they got the active lifting licenses, and other you know, entities who get license from maybe other place of the world. So that's our appetite. Maybe a little bit conservative.
So I'd say, so crypto is open source, open competition. Oh, can you hear me? Open source, open competition. Hello? Open source, open competition, and global. So hyper competitive. So, can you hear me? Yeah. So it's hyper competitive, which means you need to run fast. You need to keep building. You can't rest on your laurels. Or else a competitor from somewhere else, from Europe, from India, from Africa, will come and outcompete you. So that's number one. It can be incredibly powerful. So one of my early startup investing lessons from my angel portfolio was, if you find a startup that is in a hyper-competitive market, but they actually have something different and they are doing it really well and they're able to win, they can accrete in value much quicker than any other startup in your portfolio. And that's crypto on a global scale. If you can come up with the right product and you can bring it to market, that can be B2B, B2C, you can bring it to market in the right way, and you can be aggressive and continue to press forward, and even when you start seeing success, you continue to press forward aggressively, you can accrete in value way quicker than any traditional equity business, and that's powerful. That's powerful, but you can't rest on your laurels. You have to keep fighting, and if you win, and then you take a victory lap, guess what? There's going to be someone who comes and competes away your opportunity. And that's what's scary about crypto, but that's also what's powerful about crypto.
Yeah, I'll double down on that. Like, before I was a crypto investor in the U.S., I I worked at Bain Capital Ventures. I helped start their crypto program. We did a lot of open source infrastructure software. Huge category in the West, like Snowflake and MuleSoft and all these database companies. Everything is radically open source. And that is the ethos behind crypto as well. And it's not quite as popular, but it's growing, the open source community in Asia. And you have to do that. Yeah, you have to build everything open source as early as possible. You can't try to hide what you're doing. You have to tell the community what you're building. You have to show them. You have to do as much on chain as possible, because then it's also even more, it's even more like forced to be open source. Yeah, many Asian founders don't. It's incredibly competitive, and the Beijing sort of Silicon Valley startup community is like so competitive, and everyone's like racing against each other. But you can't do that. You have to be very collaborative in crypto. Otherwise, you'll fail. You'll just absolutely fail to something that is totally open source and is more composable and has more integrations. So yeah, that was a great one. Yeah, very important, especially to Asia founders who don't think of this right away.
Yeah, I mean, look, I was an investor in Web 1.0. It was before open source web libraries, before cloud, before Google and Facebook. So the cost to build a login flow, the cost to serve your software to users, the cost to market your software were orders of magnitude more expensive. So when the market collapsed, startups died. They just died. Today, it doesn't cost that much to keep these companies alive, and you can scale quite rapidly. The flip side, as Seth and Alex said, is hyper competitive. So you just have to keep moving. Like, crypto is incredibly capital efficient. It's an amazing time to build a startup and to scale it rapidly. People looked at WhatsApp when it sold for, was it $19 billion, and it had 13 employees or 17 employees. I mean, crypto is a giant extension of that. You don't need big teams, okay? You just need to rapidly innovate and leverage other ecosystems. There's a lot of ecosystems, so you have to pick really well on the ecosystem you're picking. We think eigenlayers are a really important ecosystem. Ethereum is really important right now. There's other ecosystems, but you have to leverage other people and let other people leverage you.
Yeah, and one point that I have that I think is, we kind of gotten to a phase in Web3 where it's no longer you build it and they will come. I personally believe that these builders have to start thinking about these pragmatic problems that need to be solved. And this is the way that you kind of get these developers to come, adopt it, build their application, stuff like that. I don't know if you guys have similar thoughts around there. I know, Alex, you kind of mentioned we're in the 90s still of development. But for these builders out here, is that something that you also subscribe to, or you think there's still more, new technologies that kind of need to be built there?
Yeah, I've been waiting for it to turn to what you're saying, where, in what we invest in the last 10 years of internet, it's like the lean startup is the hot thing, and the startup method of just like talk to your customers nonstop and build for your customers. And in in enterprise SaaS, you could just like get your first 5 customers. You could get Microsoft or FedEx or someone to pay you $1 million a year before you even built the product. And it's great, it's a de-risking, and you make sure you're building something people want. But in crypto, I don't know. It's still not quite there yet. The teams that spend a lot on traditional marketing, and no offense to the conference organizers here, to buy all these booths really early on and do all these events and after parties and club events, the ones that do that typically are inversely correlated with success pretty strongly. The ones who sort of put their heads down and build product and ship something really cool and tell the world what they're doing and build open source tech tend to do better in the long run. So we'll see.
Awesome, awesome. Well, thank you guys for sharing all your insights today, and thank you, HashKey, for having us. I thought this was incredibly helpful and hopefully helpful to you all. Yeah, thanks again. It's great to be back.
Thanks, Patrick.
Yeah, thank you. Thanks.
Thank you very much for Patrick and the amazing panelists. I just want to maybe say one thing. Some of these guys also run amazing funds. Not sure they're fundraising or not at this particular stage, but in case you're interested, they're here live in person. You can feel free to reach out to them and talk about their future fundraising plans. So just putting a little bit of plug there for the panelists right there. Okay, thank you. 我再温馨提示一下大家，就是2件事情，如果需要同声传译的话，我们门口有一个二维码，可以扫来做同声传译。另外呢，给大家准备了这个小礼品包，大家在走的时候呢可以带走。Okay. So let's get on to our next panel, and don't leave yet, because I think the next panel is even more amazing and interesting. I think we will have a great panelist talk about how to build a compliant asset management business. What are some of the parts, service providers, how to best think about it. So it is my pleasure to invite the next, the moderator for the next panel, Mr. Clarence Chun, partner of the Hang Kun Law Office, and the other amazing panelists. Please come on stage. 下一个我们圆桌会议呢，是如何搭建一个机构级别合规、全球领先的 Web3 资产管理公司。我们有请。汉坤律所的合伙人钟律师是我们下一个圆桌会议的主持人。All right, Clarence, the floor is yours.
Hello. Good morning, everyone. I'm Clarence from Hang Kun Law Offices. We have been providing legal services in virtual assets and Web3 for more than 4 years, just the time when DC just mentioned that when they established its first fund. I'm honored to have a chance as the moderator of this panel. Today, we are happy to have veterans from asset management industry in Web3 as our panelists. They are Matthew Long, Head of APAC from Falconex, Andrew Ranges, VP of Sales and General Manager of Block Diamond APAC, Abel Sell, Director of BUIDL, and Kelly Patterson, Director of Institutional Sales from Elwood. Matt, Andrew, Abel, and Kelly, thanks again for joining this panel. Shall we start from giving a brief introduction about yourself and also your firm so that our audience can have some basic knowledge about your guys' background? Let's start from Matt.
Sure. Thanks very much, Clarence. It's great to be here. My name's Matt Long, and I'm the head of APAC at Falconex. We're one of the world's largest prime brokers in the digital asset space. So when it comes to speaking about how to build a compliant asset management business, we're actually really, really well positioned to speak to that topic. My background is many years in traditional finance, trading, derivatives. I'm Australian, but I've lived in Hong Kong and Singapore for most of the last 20 years and have built a number of different trading businesses in both traditional markets, and was heavily involved in building the first SFC-regulated virtual asset trading platform here in Hong Kong over the last few years. At Falconex, as I said, we're one of the largest providers of prime brokerage services in the digital asset space for fund managers. So we provide I guess, a very technology-driven approach to providing execution services across spot markets, trading markets. We're one of the world's largest traders and providers of services in OTC digital assets, derivatives. In the US, we were the first and still only CFTC-registered swaps dealer for crypto. So we're actually in a really good place to be able to give some information and informative background around how to build compliant asset management businesses in the space.
Thank you. Yeah, and Andrew?
Hi, everyone. So my name's Andrew. I'm the General Manager and VP for Blockdaemon in APAC. My background is a little bit different to Matt's. I've been on the infrastructure side of things. So I'm we were joking on our pre-call. I'm an old school server hugger, right? I've run data center lines of business in a telco. I've spent time in traditional tech companies like Cisco. I've spent 5.5 years on the cloud side of things, and I'm just super excited to be in the blockchain industry now. So last January, I joined Blockdaemon to help build and scale the team and the presence and look after our customers here in APAC. So what Blockdaemon does is essentially 3 things. So we sit at the infrastructure layer in blockchain. We started life as delivering full nodes to the market. We're one of the largest node runners globally. We run about 87,000 plus nodes across 60 plus blockchains, and we're B2B institutional focused. So we have some of the largest traditional companies, some of the largest digital native Web2, and a large part of the crypto native companies work with us on blockchain access. We also were very early in staking. We're the largest institutional staking provider globally. We support about 36 different POS chains. And the last thing we do is we do work on the security side of things. So we have a very sophisticated MPC key management set of technologies and toolkits as well. So very much at the infrastructure, you can think of us blockchain, APIs, SDKs. We're very much at the tooling, and we support a lot of companies here that are here at the event this week. Lastly, one more thing. Yeah. Just super excited to be back in Hong Kong. It's just awesome. I've missed this city. It's one of my favorite cities. I'm 12 years living in Singapore, but just excited to be back in Hong Kong. And thanks for HashKey for setting this up. It's just awesome.
Thanks. And Abel?
Hi, everyone. My name is Abel Xiao. I'm a director at BUIDL and help oversee some of our sales and strategy with our APAC clients across this part of the world. For those of you that may have not heard of BUIDL, we are the largest provider of infrastructure in the space, so custody, wallets, and at the very core of what we do is programmatic hot wallets, the software. And on top of that, we are a regulated, qualified custodian in the US, in parts of Europe, and we've also got a prime brokerage business. So in that sense, we like to think that we cover a pretty broad array of clients, relationships, and who we serve today is really anyone that wants to enter sort of crypto or Web3, right? You have governments, sovereign wealth funds on one end, asset managers, but also listed businesses, right? The next generation of businesses that are thinking about this space. And so we thrive, right, in providing the tech, providing the solutions when clients think about the future or the future of crypto. Myself, I come from a wealth and asset management background, so hopefully can share some interesting insights that are applicable to us today as well. Thank you.
Thanks. And Kelly?
Hi, everybody. My name is Kelly Peterson. Thanks, HashKey and the team here for having me. Really excited to be on the panel. My name is Kelly Peterson. I'm a director of institutional sales at a company called Elwood Technologies. Elwood is a platform that provides order management, execution management, portfolio and risk management solutions at an institutional grade level to hedge funds, asset managers, banking institutions, native crypto firms as well. I joined Elwood 4 weeks ago. My background is in both traditional finance and institutional crypto markets. I've been in crypto since 2017. I built a couple of, was on some of the kind of initial teams for a few institutional crypto lending firms, a market data analytics company. The company was sold to Coinbase, so I was at Coinbase the last couple of years on the institutional prime brokerage sales and trading team. Prior to that in TradFi, and really excited to be here and talk a little bit more about compliance and asset management in the space.
Thank you. So in this panel, we are going to focus on compliance and other relevant issues of asset management in Web3. After several Black Swan events last year, and also the recent takeover of the Signature Bank and other crypto-friendly banks, the confidence of the participants in this industry, including institutional investors, individuals, companies, and certainly the regulators, are greatly shattered. Therefore, compliance is becoming a more and more important issue in this industry in order to have healthy and sustainable development. It's a privilege to have this opportunity to hear how the builders in the Web3 industry look into the compliance issue and how it is related to their client base and client development. So let's start with topics related to client first. Kelly and Matt, we know that a significant number of your clients are institutional clients. So what are some of the challenges faced by your institutional clients, and how do you assist them in solving these issues? Shall we start with Kelly first?
Yeah, sure. Thanks for that. I think, over the last few years, a lot of the challenges we've seen with clients have kind of evolved. Back in 2020 and late 2020, early and throughout 2021, there was sorry, I lost my train of thought for a second. Yeah, I think the challenges have really evolved, and a few years back, I think a lot of the clients were looking at, what custodian do I need to get onboarded to? How do I kind of protect my these instruments that are bearer assets? What exchanges and venues do I onboard to? I don't think there was a lot of concern basically around looking at the fragility of execution microstructures. I don't think there was a lot of concern around, how you actually manage risk. I think a lot of the clients that we speak to actually manage risk over the last course of the few years on G Sheets or Excel spreadsheets and these sorts of things. And there was a really big rush, I think, a gold rush to kind of like catch the bus. They wanted to catch the express bus. They didn't want to be kind of on the sidelines, on the sidewalk, not taking advantage of the market upside. And I think, we have seen over the course of, I think one of the guys on the last panel mentioned summer of 2022, we've seen kind of some of the market fragility really come to play across some of these execution microstructures. And I think, as a result of that, I have seen in my discussions the client behavior and the focus and the challenges really shift. So, now the discussions are more around counterparty risk. What counterparties do I have exposure to? Have I done the right due diligence and the right kind of AML, KYC checks on these counterparties? Where is my risk spanning across these different venues? What type of governance do I have in place? Am I comfortable with my company's policy engine? Do these custodians have the right consensus mechanisms in place that I'm comfortable with from an approval perspective? What does my operational risk look like? Moving assets across the ecosystem. Can I mitigate, these sorts of risks? So I think this is kind of where I think the conversation has evolved. And I think Elwood, and I've only been there, a number of weeks, but I think we're really well placed to kind of help with that. So we have set up a order management, execution management, and portfolio management platform. And it allows clients basically to help with some of the fragmentation in the market. So they can seamlessly execute across more than 20 venues. They can see their overall positions. From a portfolio management perspective, we're basically like a digital ledger between CeFi and DeFi. So that helps a lot with reconciliation, with P&L, with reporting, with post-trade compliance. We're seeing from a lot of the hedge funds and banks and asset managers, and even the LPs in the space, like they're forcing kind of their underlying portfolio companies and investments to provide reporting to them, provide transaction activity, right? So they can get closer and a better understanding of what's going on with their investments. So these are the kind of conversations we're having. The last thing I'll say is what's come more to the forefront as well is from a risk perspective. So Elwood offers advanced risk analytics and tools for clients, and that's really helping clients think about, what are my risks that are out there? What is my exposure? How do I mitigate those risks? And how do I minimize them?
Awesome. Yeah, and thank you, Kelly. And Matt, do you have anything to add on this?
Yeah, sure. Look, I think Kelly's spot on that the challenges just keep changing throughout as we move through various cycles. And so I think that the challenges faced will actually depend on what type of customer and what type of institution is coming into the space. So, for example, I can think of a number of large regulated institutions that that we've worked with for like more than sort of a 12 to 18 month period to bring them through the entire journey of coming into crypto markets and helping them understand market microstructure and really helping them understand how to think about all of the different aspects of moving from those that are coming in from traditional finance. Why is market microstructure different? Why is counterparty credit risk different? Why is custody different? A lot of assumed knowledge coming out of that type of client, those that are coming from traditional markets, some of it doesn't apply when they move into digital asset markets. What's really interesting with a lot of those clients, and I'd actually pick up on a point with you here, Clarence, most of the large asset managers, banks, fund managers that we talk to basically have not blinked about their commitment to the digital asset and crypto industry after the events of the last 6 months.
Yeah.
Most of them are actually of the view we are committed to digital assets as an asset class. Blockchain is the underlying technology that's going to rewire financial services. And as such, most of them are saying many of these events are actually a positive thing because they're allowing risk to be repriced. So the way that we look and the way that we think about risk in markets is being repriced. And the things, as Kelly said, counterparty credit risk. Again, 12, 18 months ago, again, as a traditional finance guy by background, I was looking at some of the counterparty credit risk in the market going, clearly I'm a dinosaur that doesn't understand some of these trades that are being put on. But and that's why I mean some of those things are coming to, back to fruition now and helping others. How else do we help? I mean, so again, I said it depends on the type of customer that are coming into the market to help them address different challenges. So we actually announced last night that we've just launched a ChatGPT powered bot to help a range of our clients invest into markets. And so again, as a large prime broker that helps execution into crypto markets, there's a couple of things you have to remember and why a service like this can help clients. Around 70% of global crypto markets does not go through exchanges. So that's really important to remember. Most of the flow that goes through markets does not go through exchanges. It goes through the dark markets and through OTC businesses. So that's sort of number one. Number two is probably 55% of the flow that goes through markets is by high-frequency traders who are market neutral, be they long-short funds or high-frequency traders and arbitrage funds. And those types of traders typically have large quant teams that allow them to assess markets and to invest. So that leaves about 45% of investors and traders without access to quant services. And so that's why we've actually released this bot built on ChatGPT that will allow 45% of our clients, asset managers, families, to use an AI service and a generative AI service to do things like aggregate information. So if you think about one of the challenges for investors and traders in crypto markets, information's everywhere and it's instant. So the first use of our ChatGPT service, which we've called Satoshi, will be to actually aggregate in from Twitter, from YouTube, from podcasts, actually pull in data that can be used by those 45% of traders that don't have big quantitative teams. And we hope to evolve that then to allow them to say, well, what's a trading strategy that allows me to optimize my view, and ultimately build that down into how we help them invest into markets. So as I said from the top, depending on who the client is, we help them with different solutions and address those challenges as they come into markets.
Okay, thank you, Matt. It's interesting to know that for those events in past 6 months actually helped this industry, right? And then, yeah, it's also good to know that what FalconX has been doing in this industry. Okay, so helping clients to solve their issues is not easy. You need to pay attention to their needs and what they really want. You need to respond very quickly. So Andrew, have you observed any changes in the types of clients you serve as well as their interests and demands?
Yeah, thanks for the question. And great bot name too, Matt. I hope you have the global trademark. I think that's a winner. Yeah, so, and back to your question here, Clarence, we've seen quite a few changes. If I take a step back, our CEO, Konstantin Richter, he's done a great job of thinking through transitions. So a couple of years ago, he was very focused, before all of this, these market events have happened, really focused on compliance, clarity, transparency. So in our market segment, we actually don't sit in the regulated space. We're adjacent to that, as a technology provider. But we've been going through the motions for the last few years. There's a couple of key points I want to make. I think if you look at Blockdaemon, and it's quite public information, if you look at who's funded us, there's a mix. The largest funding has come not from crypto VCs. Very, very traditional people. JP Morgan, Goldman Sachs, Citibank, Salesforce, so we've got a very traditional investor base. And that's helped align the company from a compliance perspective, regulatory perspective, to institutions that want to be in this space but have asked these questions. Hey, how do you do KYB? How are you doing these processes? So I think we've been really fortunate to be building all of that, compliant infrastructure out for years now. And it's been a real differentiator for us since we've started on that direction. We have fully audited books. We disclose our board structure to our customers. We do all of those things that more traditional institutions are looking for when they select a provider. I think what's changed recently is we now deal with the largest of the large, like brand names from Hong Kong, Japan, Singapore. These are well-known institutional entities coming into this space. They do come in differently. They usually are coming in at the Ethereum kind of protocol from us, from a staking perspective or a node access perspective as well. And then, how they engage with us, I almost have some flashbacks to my Cisco days, a very heavy enterprise sales motion, lots of documents, lots of contracts, spending a lot of time on SLA, the risk section, these sorts of things. I think the diligence process now for large enterprise and institutions in the crypto space is on par with that sort of very large enterprise Web2 TradFi. So I think that's been a really good thing. It does mean a few of my deals and for the team have slowed down a bit, but we've been dotting the I's, crossing the T's. These large institutions, for example, we were the first staking and node access company with proper insurance. We're insured for slashing, double signing. We're insured by industry leaders like Marsh and Realm. And I think 12 months ago, people would be like, hey, that's cool, nice bullet point on your slide deck, let's keep moving. Now they're like, no, okay, let's dig in, I want to see the policy. So I think that's a good example of what's changed, yeah.
Okay, thanks. And Kelly, do you have some ideas on this topic?
Yeah, I think I can add a lot to what Andrew said, and I think it's, I agree with a lot of what he said. I think, as I kind of alluded to earlier, I think the conversation, the interest is still there from some of the large institutions and the tier 1 and large cap firms, but I think kind of the conversation and the dynamic has shifted slightly, and I think after last year, there has been, while there's still a lot of commitment, I think we've seen just a bit of an air of kind of nervousness from some of the larger institutional players in the space. We have, similar to the guys at Blockdaemon, a really nice kind of cap table, the Goldmans, the Barclays, the Citis, et cetera. And across the board, we're seeing from some of them and others as well, real continued interest. But I think it's less about some of these firms early on trying to catch that gold rush. I think it's more now about taking taking a step back and really thinking systemically about what tools, what systems, what infrastructure do they truly need in place to be able to build a real kind of business around this from a risk perspective, from an operational perspective. And I think that's something that is really interesting today. And I think a lot of these established companies as well are looking, not just at bringing on the custodian or bringing on a venue. It's really around that next layer down, right? And I think, for not to kind of toot our own horn, but I think Elwood is providing kind of that layer, that additional kind of layer down that's giving them access to the entire ecosystem. These companies now can basically more effectively and appropriately look at things like, how can I, effectively and appropriately trade a strategy? How can I backtest? How can I kind of shock the market? How can I do kind of like scenario analysis on my portfolio or on a specific strategy within a fund within that portfolio? How can I do vol? Can I do VAR calculations, for example, value at risk calculations? These are all the things that we're starting to see, and I think that's a really good sign as companies kind of get more comfortable with the tools and the infrastructure in the industry. That's going to allow for more, robust counterparty interactions. That's going to eventually allow for more volumes to come through the industry and the ecosystem at large. The other thing that I'll say is that a lot of these large companies, and I've been in the industry now since 2018. They all have been committed to the asset class in some way, shape, or form, right? A lot of them have built out crypto units. They have project managers that have come on board and manage various complex, multifaceted work streams across the organization. They're going through product approvals and committee approvals at these large banks. They're getting, exec committee sign-offs on this stuff. So these things are really serious, and they take months, if not years, to get sign-off. Sometimes, the pace isn't at the pace that we want to see it at, and it's not linear, right? They might take 2 or 3 steps forward and 4 or 5 steps back, and then another 2 forward. That happens. But I think long term, we're starting to see, the right kind of layer of infrastructure in place now. These companies looking at how and what use cases are out there, how this asset class, how this technology is going to disrupt their current business models, and starting to look at testing that in various ways, shapes, and forms. So I'm really excited about that. I'm really excited about kind of this next layer of infrastructure coming through to kind of pull the ecosystem together with all of the venues and trading partners, custodians, etc. And let's see how it goes.
Thanks, Kelly. It's always good to know that you all builders, what you are doing to improve the compliance system and to improve the whole industry. Thank you. So I know all your firms cover multi-jurisdictions and you're providing your services all around the world. So how do the requirements and regulations differ across regions? I guess, Abel, you may have something to elaborate on this topic, given that BUIDL provides custody service to customers all around the world, right?
Yeah, you're right. And there's really 2 parts to this, right? There's the regulatory aspect and the requirements as well, right? So let's start with the regulatory component of things. You're right. We as a business operate across multiple jurisdictions globally. But lest we forget, we're also a pretty heavily regulated business. And that means that we have to be cognizant of the regulations within the jurisdictions that our clients operate in. So that's key for us. And taking a step back, BUIDL, not only are we a qualified custodian, i.e. wallets with insurance, regulated, etc., but we're also a type provider with our programmatic hot wallets, which I alluded to just now. And that gives us pretty wide reach with a lot of depth as well. So today we have in excess of 1,600 clients in over 50 countries globally. And while we would love nothing more than to offer the full suite of our product offerings to every single client in every single country, the reality is that we first need to get legal clarity, we need to get the right approvals, and therefore calibrate our approach in the right manner. And that's fine. It's something that we have come to appreciate a lot over time. And of course, that makes the work that we do, the consultations that we have with regulators, very important to us. right? So what do we see today? In the US, as the last panel mentioned just now, as we've alluded to, there's a lot going on and it's pretty well documented, pretty well covered. And while the regulators over there have not often come out to tell us what we should do, as opposed to what we cannot do, you know this very well. One thing that they have come out to say is that if you are an RIA, a wealth manager in the US, you must use a qualified custodian, which obviously is what BUIDL is as well. And we think that globally regulators will take this lead as well, not least because this satisfies at its very core investor protection. But I think where things get really interesting is over here in Asia, because what the regulators in Japan, in Korea, even in Indonesia, and of course in Hong Kong are thinking, are doing, are a little bit different from each other. And they're all starting from different starting points as well, right? But one thing's for sure, and I think we can all agree, is that the regulators are taking a more active role in the business, and we need to be prepared for it. So to the other part of your question, the requirements, right? Then to be honest, as a business, from what we see, the requirements are pretty similar, pretty standard across the board, because we have one job as a custodian, which is to not lose client funds, right? To safeguard their assets for the long term. So in that sense, because we've been around for 10 years, we have some experience, clients really look to us for leadership in this sector. They want our advice, our counsel. And we say to clients to think of us, think of BUIDL as an extension of your team. Pass on any feedback that you have from your users, your clients, so that we can work together to build better infrastructure, to better enable access into Web3. And so if you are a business looking to pivot into crypto, incorporate digital assets, or if you are a builder looking to jump into the space, we're obviously very happy to have a chat, share our observations, share our learnings, and discuss market trends where applicable.
Yeah, you have something to add, right?
Yeah, I wouldn't mind quickly jumping in. So, you know, as we said, so Blockdaemon's really at the infrastructure, the lower level infrastructure space in blockchain. So, you know, what I'd quickly like to point out, what's interesting is, you know, we shouldn't forget that blockchains are cryptographically secured and there's encryption in there. So what that means from a regulatory perspective is encryption in some jurisdictions has export controls. So we're actually in Asia right now, you know, we might even just be deploying Ethereum nodes or a protocol, and there's, you know, getting very specific requirements around, well, how are you going to run that? Where are you going to run that? Where is our nexus of center of excellence for that protocol? Like, we've just been through a very large project with one of the largest funds globally, and they were assessing us for where was our nexus for our staking line of business. Because if that was in one jurisdiction in the Americas, they couldn't do the deal. But if it was not in the Americas, they can partner with us. So even, you know, even at the lower levels, the regulators are looking at this stuff, which I think is great. I think it's healthy. In Blockdaemon, we're set up as multi-jurisdictional. So it's quite common for us that we'll run our staking business like out of Ireland. Because actually what's interesting, on the blockchain and the export, encryption, and staking side of things, Ireland, and it's not really spoken about a lot, but Ireland is very pro blockchain. So, you know, and then if we do other projects, we may use another jurisdictional entity, and we're very deliberate around not only, it's not just where we're contracting, is where are the engineers? Like, who's delivering the service? So that's the concept of, like, where's the nexus of the capability? So even at all layers of the stack, whether, you know, you're a regulated, qualified custodian, or even you're delivering like blockchain infrastructure, like these conversations are coming up nowadays. And this is on the newer side of things as well, you know, yeah.
Okay, thanks, Andrew. As we have mentioned in the beginning, quite a significant number of you guys' clients are institutional clients. So Matt and Abel, other than financial institutions, are you seeing an increase in the number of established companies and corporations joining your client base? And how do they think about compliance and running their business? So Matt, maybe your turn first.
Sure. Yeah, so look, many of our clients are regulated financial institutions, but certainly what we've seen, you know, and this is a thematic that I think permeates the market, is that there are more and more different types of investors and traders wanting to invest into blockchain markets and digital asset markets. And so that ranges from, I guess if we take sort of financial institutions, regulated institutions out at the top and start moving down the stack, unregulated market-making firms and proprietary trading firms. And you know, there's an enormous number of those across Asia, across Hong Kong, other markets in Asia. And so I think there is, we see, and as I said, this permeates across all markets and timeframes. Traders who have set up new businesses, traders that are looking to generate alpha, investors who understand how to price and manage risk and look at digital assets just as another way to add alpha into their portfolios. So we continue to see that at, you know, from market making and from proprietary trading firms. The other very quickly growing segment across this region are family offices, obviously. You know, the way that the average Asian family office allocates into markets is obviously very nuanced. And so there is obviously a very high appetite for high beta, high alpha products like digital assets, like OTC digital asset derivatives. And so, for example, one of the fastest parts of our business which is growing are OTC options and OTC structured products that we see appetite from families for. So again, when they're thinking about how to allocate and where they're allocating across their portfolios, from property down at one end of the spectrum, you know, listed property markets, VC, there's a very large part that goes into you know, OTC derivatives, structured products, and that's now migrating into digital assets as well. So the family office segment is obviously growing really quickly as well. With respect to compliance, it is, you know, if we think about the things that top the list when investors and traders are moving into this space, compliance is kind of number one. You know, it has grown. Yeah, I mean, if you think how crypto markets have evolved over the last 13 years, 14 years, you know, we've moved into a world now that this is a regulated asset class. And if you look at if you look at FATF and FATF's view, you know, they want to see a world and where there's globally synchronized and harmonious regulation across all of the markets, like there is for, you know, or increasingly is for other assets as well. So as new entrants come into this market, perhaps, you know, some of our clients that moved into crypto arbitrage, cross-exchange arbitrage, basis arbitrage 7 or 8 years ago weren't thinking about compliance. They were thinking about engineering. They were thinking about on-ramps and off-ramps for fiat. They were pretty comfortable with how to keep private keys, and they weren't thinking about compliance. Completely the other end of the spectrum now. It's like compliance is the legitimacy to be able to operate and run a business, particularly for those that are looking to bring in outside money. You know, having a compliant infrastructure in place is just fundamental.
Okay, thank you. And Abel, can you share with us from BUIDL's perspective and how your client think on compliance?
Yeah, I mean, it's a really good point that, you know, Matt brought up just now, and absolutely right. You know, we definitely see, you know, clients outside of financial services, outside of those thinking of crypto as an asset class, coming into the space, because at BUIDL we're in a pretty fortunate position of having a front row seat, right? Having a preview as to what's going to come in digital assets over the course of, say, the next 9 to 12 months. And the reason is because when you are a Web 1, a Web 2 business, a family office, thinking about crypto, thinking about incorporating digital assets, the first thing you're going to think about is really the infrastructure and the security of that infrastructure. And that's where we come in, and that's where those discussions take place. So I think from our point of view, there are really sort of two camps. In the first camp, you have firms that have done the work, have kicked the tires, and with the bear market, crypto winter, whatever you call it, they've said, let's put those plans on hold, or no, now's not the right time. And we get it, because a lot of times this is in response to appetite from their own end clients, their own end users. And then you have the second camp, firms that have formalized a Web3 strategy. They've gone out to hire teams, they've gotten the blessings from senior management, and today they're very much in the implementation stage of where they want to be. And I think it's fair to say that the number of participants in this camp outnumber those in the previous camp. And that's what makes the work exciting for us, because we see it across gaming, entertainment, consumer-facing businesses, e-commerce, sports, just to name a few. And from where we sit, is then about pushing the boundaries of what the tech can offer to ensure that the next generation of users are onboarded. And oftentimes, they don't even realize that the entire thing is powered by blockchain. So to that part about regulation and compliance as well then, the truth for us is that as a business, we have a very high regulatory and compliance bar to meet, to just be around, because we're so heavily regulated. And therefore, the kind of clients that we work with, that we attract, tend to be those of a similar risk profile, those of a similar outlook, view of the world, i.e. to say these clients are extremely risk averse. They simply do not want to be caught on the wrong side of any regulatory net, right? And so unsurprisingly, these are your sovereign wealth funds, your governments, but also your regulated fund managers. And interestingly as well, a lot of these are traditional firms that are listed companies, sort of Fortune 500 companies coming into the space. And that's on top of our crypto native client base today. Staking is a very good example because, it's obviously a very new offering in an industry that is in itself very new as well. There's just no precedent to this in any asset class. And unfortunately, the regulators have not given us much guidance as to how this should be managed in their eyes. And therefore, it's incumbent on us to work with our partners, to work with our clients, to ensure that not only are their business needs continue to be met, but being done so in a manner that's as compliant as possible. And I think clients are well aware of this. Right? For them to be successful, they need to earn the trust of their end clients, their end users. And a big way to do this is to demonstrate that they are working with regulated players, that they want to be compliant with the regulations in their jurisdictions. And this, of course, goes to show that they are serious about being around for many years to come.
Oh, thank you. So, Andrew, you have something to add, right?
Yeah, just quickly. So BitGo's a fantastic partner. We partnered together for many institutional customers. And even though, and I just quickly want to say, because I think you nailed it, like Blockdaemon has been very early in the staking space, but really now, Ethereum, Shapella, Shanghai is where the institutions are coming now. So we've been doing this for a very long time, and we've met a lot of institutions that have simply said, we should have done this 6 months ago. We know we're just going to wait for Ethereum upgrade, and then we're all in. So I think now is an exciting time for regulated custodians. Like I said, we partner really well and closely with BitGo, but the inbound from traditional institutions who've just gotten over the line on digital assets, getting into staking, have seen Ethereum Foundation do multiple successful upgrades, I think this is a really exciting and pivotal time right now.
Yeah, that's true. Especially when the Shanghai upgrades was complete the day before yesterday, right? Yeah.
It's really exciting.
So, Kelly, you just mentioned about something about counterparty risk, and I would like to dig into it more. And so I know that Elwood provides connection with exchanges, liquidity providers, and also other institutions. And you know, sometimes there may be risk associated with our counterparties. Some of these counterparties may collapse just like FTX. So how do we segregate the risk from the counterparties so that when they are in trouble, our clients will not blame on us? Yeah.
Yeah, I think it's a really good question. Thanks for that. So Elwood is a SaaS platform. We're a software kind of layer, an aggregator that sits across like all the institutional ecosystem out there for our clients to integrate into their current trading tools and systems. So we don't specifically segregate risk on behalf of our clients, but what we do is I think we do a really good job of giving them and facilitating the tools for them to be able to do that themselves. So we have a risk management side of the platform that basically supplies risk measures and metrics based on proprietary models. We have a team of over 20 quants that works directly with our clients to help clients look at their various kind of risk metrics that may be important to them. So, you know, when you think about all the market information out there and the way that clients might be looking at how to manage their portfolio, you know, you have consensus and divergent market information, and I think kind of our risk platform allows them to enrich their understanding of their overall market position, their portfolio. It gives them that deeper understanding to make decisions. So basically, we're allowing a lot of our clients from a risk perspective, based of course on their own risk appetite, to come up you know, with the best way to manage risk. And I guess some examples of this are, for example, we have you can price risk within our platform. So say you want to do a trade and you want to hedge that trade. You know, you could price out that hedge and you could think, you know, am I mitigating, you know, kind of that local risk in its entirety? Am I pushing that out forward? You know, if I were to shock part of my portfolio or my entire portfolio, say Bitcoin, I don't know, goes up by 20%. If I shock the portfolio, like how does that kind of affect my P&L? You know, what's my P&L currently? Can I estimate my P&L in 14 days, 60 days out? What does that look like? So there's all these sorts of kind of like functionalities within the tool that I think really gives clients a much deeper understanding of their ability to kind of manage strategies, manage their overarching portfolio. And I think from a financial institution perspective, they're very much used to this kind of tech stack and this kind of trading infrastructure in their day-to-day operations when they currently run strategies. So having, you know, these sorts of tools starting to catch up within crypto, which was primarily, you know, really driven off the back of retail demand, I think is something that's going to just continue to facilitate, you know, a healthier market, a more transparent marketplace, get, you know, these sort of funds and larger tier one, large cap firms ready to continue to adopt into the space. And I think that's really exciting both from Elwood's perspective and, you know, we have some competitors in the market as well. And I think it's a really good time to really focus on the risk side of things, given everything we've seen over the course of the last 6 to 9 months.
Yeah, Andrew, do you have something to share with us? As I know that Blockdaemon also provide API for staking. Yeah.
Yeah, and I think I probably half answered it off the back of like Abel's kind of answer as well. But I think we are seeing, you know, our institutions look for alternative ways to actually perform staking functions. So, you know, we deliver that via partnerships with BitGo, for example. And, you know, we deliver actually our solution via BitGo to institutions via APIs. So I think, you know, if you looked at staking a couple of years ago, it was a person in the treasury team with a wallet, right, going, I want to do a delegation to a Blockdaemon validator, execute the transaction. You know, now we're moving into a world where applications, licensed custodians, regulated custodians can just onboard to our API and perform these functions. You know, it's not uncommon for us now to see an institution like in a BitGo, for example, and come along via the API and order 1,500 validators for Ethereum and just execute a transaction. Where previously that's going to be, 1,500 divided by 32 ETH, individual transactions. So I think, some of these things and properties on the technology side that we've had in the Web 2 world, like very powerful APIs, are coming into the blockchain world as well, which is going to drive transparency, consistency, programmability, scale as well. So I think this is quite an exciting time as well, as the infrastructure is maturing rapidly as well to service institutional clients, not just a retail home user that's doing one small delegation transaction. Yeah.
Okay, thank you, Andrew. We are running out of time, so ladies and gentlemen, please give a round of applause to our fantastic panelists. Yeah. Also, thanks everyone for joining this panel. I hope you enjoyed it. The next panel will be Web3 Open Mic. There will be presentations from several HashKey Capital's portfolios. Stay tuned.
Yes, I was going to say, do not go anywhere. We have the open mic or demo day coming up right after this. And thank you very much again for the panelists and especially the moderator Clarence. Thank you. 大家不要离开，我们马上就有我们的 open mic 或者 demo day 的环节，应该是有5到6家全球领先的 Web3 的公司的项目方，每家机构会介绍10到15分钟他们的项目。So as I was saying, we have the open mic coming up right after this, and there's going to be 5 or 6 amazing, folks from some of the top Web3 projects and companies globally, and each one of them will talk about 10 to 15 minutes about what they do and why their projects are amazing. So we're just going to get the stage set up, and we'll start the open mic portion immediately after this. Okay, so we have, in the next an hour or so, we have 6 amazing Web3 companies that will each talk about 10, 15 minutes. We have Celestia, EastSign, ChainSafe, ZetaBlock, Reap, and InfStones. So first up, where is Mary? We'll have Mary Liu from Celestia, who will talk about, oh, there she is. Hello, Mary. Yes, let's give a warm round of applause to Mary from Celestia.
Thank you. Hi, and good morning. My name is Mary Liu, and today I'll be talking about the first modular blockchain network, Celestia. So first, a little bit about myself. One second. A little bit about myself. I'm in the business development team and strategy team at Celestia. I was previously at Galaxy Digital as a fund of funds investor and at JP Morgan as a software engineer. As a fund of funds investor at Galaxy Digital, I had the chance to see an overview of the entire institutional market, of what companies, projects, and venture investors were investing in. That's why Celestia really stood out to me. And then I earned my degrees at Tsinghua University as a Schwarzman Scholar, as well as Columbia University with a degree in applied mathematics. So the agenda for today, I'll first start with an overview of modular blockchains, because that is the paradigm shift that we're working on at Celestia. And then I'll go on a deep dive into Celestia itself. And then finally, I'll talk about our product, Rollkit, which we've built to ensure a better developer experience. So modular blockchains. I'll just let that sit for a second. Modular blockchains decouple the core functions of any given blockchain: execution, settlement, consensus, and data availability. The primary bottleneck with Ethereum scalability was data availability. Because each Ethereum full node has to download every single data from every block, Ethereum had trouble scaling. And that's why Celestia chooses to focus entirely on data availability. So here you see the image of the 7 layers of the OSI model. Every application we use today, whether it's Twitter, Facebook, Instagram, all sits on top of this stack. Why doesn't crypto infrastructure look like this stack? Crypto infrastructure previously has been composed of monolithic blockchains. Every blockchain of the past, every blockchain that has come out over the past couple of years, the alternate layer ones, have been monolithic blockchains that couple together the core functions: data availability, consensus, execution, and settlement. Solana, Near, Ethereum were all monolithic blockchains. So what is a monolithic blockchain? First, you have the monolithic era of the past couple of years. The first innovation, of course, was Bitcoin as a digital asset, which we think of as a calculator. And then along came Ethereum, which was the first general-purpose smart contracts platform. Finally is Celestia. So Celestia is the first modular blockchain network. Now we decouple execution, settlement, consensus, and data availability. Behind me is an overview of the configurations on Celestia. So you can see, reading from right to left, sovereign rollups, and Celestiums. Sovereign rollups preserve a chain's ability to fork. So you can deploy your own chain on Celestia's data availability layer. So a sovereign rollup preserves an entire chain's ability for execution and settlement, which means that every application that deploys as a sovereign rollup preserves its own right to fork, as well as its own full ownership of its stack. Celestia then provides consensus and data availability. You might have seen over the past couple of months a number of ZK EVM rollups launch. With these layer 2s launching, signal the adoption of modular blockchains. So you can imagine rollups on top of settlement layers, such as Ethereum, that use Celestia for data availability and consensus. Finally, you can have a Celestium. So a Celestium is a rollup that sits on Ethereum for settlement and consensus, but use Celestia for data availability. Now you can see the progression of the computing writ large. So the Web 2 cloud stack to the Web 3 modular stack. The Web 2 cloud stack emerged as a consequence of data becoming much too large in order to keep on a single computer. So folks had to shift over to cloud servers. Similarly, in crypto, you can see that transactions have scaled to a size such that a single monolithic chain cannot process all data in like any, a single monolithic chain cannot contain the amount of data that needs to be made available for different user applications. So you can imagine as more user applications scale, from NFTs to DeFis to DAOs, all that data can be stored and made available via Celestia, via more specialized data layers. So how does Celestia work? Light nodes in Ethereum check block headers, but that's not secure enough. In order to make it even more secure, Celestia light nodes go through multiple rounds of sampling block headers. And that's what creates the security around ensuring that all data are made available, verified, and ordered correctly. What is data availability? Data availability is simply the downloading of all data in a block. Celestia randomly samples block data in order to make sure that block data is accurate and available at a scalable and cost-efficient manner. This is different from data storage, which is the historical representation of data in a blockchain. So Celestia data availability is not the same as data storage, as you might find with IPFS or Filecoin. Now, looking at monolithic and modular designs. So previously in Ethereum, Ethereum full nodes had to download all data in a block. In a modular design, light nodes only download enough data in order to ensure accuracy of that data. Now, the benefits of building on Celestia are immense. Building on a shared security layer allows projects to inherit the security instead of standing up all validators themselves. Previously in Cosmos chains, had to work with sets of 100 to 200 validators and then build those validators themselves. So sharing that security eliminates that overhead and allows chains to deploy their own blockchains and then own the full stack of the underlying chain that serves the application. So monolithic versus modular on shared security. Monolithic chains do not inherit security, which means they do not share security. So all alternative layer ones, Solana, Near, et cetera, they all have to build their own validator sets in order to ensure security. Modular blockchains, however, can inherit security from Celestia. Now I'll dive a little deeper into sovereign rollups. Sovereign rollups are made especially easy with Celestia. Recently, we rolled out our RollKit product, which is a rollup SDK, which creates a framework for folks to deploy rollups easily on Celestia's data availability layer. So digging into RollKit more, what that looks like in practice means that you can use any virtual machine and deploy that on Celestia. So developers can preserve developer environments that they're more comfortable and more familiar with on a rollup on Celestia. So not only do you own the full resources of your chain's stack, you own execution as well as settlement, and then use Celestia for data availability, you can more easily deploy rollups via our RollKit. So if you look towards the smaller image on the left, you can use execution environments ranging from the Cosmos SDK to CosmWasm to Ethereum virtual machines, as well as Solana virtual machines. And you can imagine the universe of products that are unlocked now that developers can not only deploy their own blockchain, as well as preserve the developer environment that they're most comfortable and most friendly with. I'll spend some time talking about projects that are building with Rollup SDK, our RollKit product. First, we're working with a gaming project that's modified the Rollup SDK so that on-chain games can plug easily into the gaming engine that he's created via our Rollup SDK, while using an EVM settlement layer where all liquidity and assets can sit on. Thus, assets can port more easily into these on-chain games that plug into his gaming engine. Other projects that we're working with include Rollups as a Service projects. So Rollups as a Service projects enable customers, clients, whether they're enterprise or individual retail users, to deploy their own chains more seamlessly. So public projects that have been announced include Eclipse and Caldera, which allow folks to deploy EVM and SVM rollups, as well as optimistic rollups. They're already working with gaming companies as well as DeFi protocols to build their own app chains or app rollups. Finally, you can contact me at any of the links above. If you're interested in building with Celestia, building on Celestia, I'm happy to chat. These are both my Twitter and Telegram links, and then I've since learned to get a WeChat to chat with developers in China. Thank you very much.
Thank you. Thank you very much, Mary, for that strong opening. Okay, next up, we have Xin Yan from East Side. So welcome.
Thanks. Hello, is it singing out? All right, it's nice to be here, and shout out to HashKey Capital for having me here. So a little bit intro about myself. Like my crypto journey started at, I think, as a hardware engineer. Like I started with building something to mine shitcoins. And then I invest in crypto for 4 or 5 years. I invest in mostly Ethereum infrastructure, public chains, and crypto exchanges. And around like 2 years ago, I started eSign. So at eSign, with a simple name, we got a very simple idea to allow people using ParaKey to sign legal agreement. Because I think the idea is pretty simple. Web3 is all about using ParaKey and using smart contract. So without ParaKey, you can't really say your product is about Web3. So right here, we're doing it in a very geeky way. We build a fully decentralized architecture for it. So basically, you generate your signature with your ParaKey in your browser, and you encrypt all the contracts, all your signatures, and we put them to decentralized storage. So, and later on, if you want to verify your signature, you just simply put your contract back to the browser, and it will work like block scan, and we will check all the on-chain data for you to verify if the signature is valid or not. So right now, we already have around like 200K users on this, and there's a lot of DAOs and I would say market makers interested in our product, and we decided to move on. So we're thinking how we can best use a smart contract. What if we can use smart contract to execute the term in the contract? So we take a look at, so with the 200 users, what kind of contract they sign the most? And also, what's Ethereum do the best job right now? So here's the top 20 gas contract on Ethereum. It basically says what Ethereum do the most, right? So you can take a look. You figure out like, so basically everything is around token like asset issuance, whatever ERC20 or ERC721, or like trading, right? So I guess Ethereum provided us a very powerful framework to launch token and to trade token. So we're thinking of building around that. I guess my observation while I was investing, I guess Web3 investing is totally different compared to Web2. So there's several points. So first one, Web3 startups usually have a lot more investors in the very, very beginning, right? Party round in crypto is we would love party round, right? We love to have more angels, more investors from different places. So here's the second one. Crypto is more globalized, right? So like compared to Web2 companies, you usually raise from your friends, your big backers, they're usually from your home country, but in crypto it's not, right? Asian startup trying to raise more money from the other part of the world, and the American companies also need HashKeys backup, right? So in that case, if a startup is in a very early stage and they need to handle the legal complexity across different jurisdictions, it's difficult. It's a pinpoint. That's why in crypto right now we tend to apply legal templates, right? We're using soft, we're using safe and token warrant, and we don't discuss terms that much. So I guess it's an opportunity for us to build smart contract for it, right? So this is a Google spreadsheet. So this is also what the founders right now use to register token ownership, right? So as I just said, crypto, in crypto market, the secondary market and primary market become closer, right? So which means investors can exit in a shorter term, usually 4 to 5 years. So they tend to invest more in the beginning. They tend to invest more aggressive. So there's more and more crypto startup raise more than 50 mil in different rounds, and right now they have nothing to use. They only use spreadsheet to managing all the co-founders, employees, and investors token allocation right here. Imagine that. So we're trying to build a smart contract backed interface to help to help founders to register everyone's ownership to the token on Ethereum. So before you launch token, use smart contract and e-sign token table instead of using your spreadsheet. So here I will give a brief walkthrough of the product. So basically on the data dashboard, you can we're gathering all the data here. So what's the planned allocation, like how much % for what use, and also who's the top holders, and what's the unlocking schedule for different roles, right? Like founders, investors, and also like how many rounds you have raised and stuff. And also with the help of e-sign signatures, we already have that product where we can help user go through the fundraising process on our platform. So here you can manage your different rounds, like C round, Series A, Series B, and you type in the term here. You just need to type in. And with the contract templates we provided, and within every round, you also need to manage an investor list. Who's your investors? And just tell us what's the term. And there's the action buttons right here. So you either upload contract if the contract is not standard. If the contract is standard, you just click invite them to invest, and we will help you send an email to them and build an investor portal for the investor. So here's a template. We're working with Animoca and OrangeDAO to provide all the safe and token warrant templates. And here's the investor, what investor sees. So as an investor, after access to token table, you will see the basic term of this deal and also the contract, and the contract is right there. So you just one click, you can sign the contract and wire the fund in one transaction. And after that, after the transaction is confirmed, your ownership to this project will be recorded into token table. So I guess that's the beginning of bringing things together. So I think right now investors, especially angel investors, they have a headache of using different platforms. They're using Carta, DocuSign, different bank account, and also like there's a different custodian wallets, right? And we're trying to adopt Ethereum standard, including ENS. And there's a new one called EAS, Ethereum Attestation Service, and also their basic wallet, and in the future, account abstraction stuff. So we're trying to use them all to build everything just on token table. So instead of using many, right now you can manage your portfolio and manage your cap table on here. And also, I think this is the beginning of using smart contract. And after we have all the token locked in the smart contract and to unlocking to your investors and all the stakeholders, there's more we can do. Say, there's something called cash flow in traditional finance, right? If we take unlocking smart contract as a token flow, right, we can wrap different token up to form some sort of a CDC, right? I think like financial audience are pretty familiar with the term. So, and also with everything under same system, under the private key system, we can also help you wrap your locked token. If you want to sell half of your unlocking token, which is still locked, to another guy, and we have the complete trace of when you sign a contract, when you wire the fund, and how much token left for you in the smart contract. We can wrap them into a NFT, we call it a future token. And after someone purchases future token from you, and we will build a token-gated platform, so the future token holder will keep claiming the rest of the token. So I guess it's all the beginning, and we'll continue to explore more on this aspect. Thanks.
Thank you, Xin, for that. Okay, next up, we have Elizabeth Kuka from ChainSafe. So Elizabeth will spend 15 minutes or so talking about how what ChainSafe does and how amazing it is. Let's give a warm round of welcome to Elizabeth.
Hi, everybody. My name is Liz Kuka. I'm VP of Business Operations at ChainSafe Systems. A little bit about ChainSafe. We've been around since 2017. We're 125 people. We have 3 offices, with our HQ being in Toronto, Canada, an office in Zagreb and Berlin, and a virtual entity in the United States. We're highly distributed. And are based in over 33 countries. A little bit about myself. I started watching the blockchain and crypto space in 2014 and joined full-time in 2018 when I joined Ethereum Classic Labs as the executive director, helped launching the first accelerator for ETC, as well as working at the parent company, Digital Finance Group, where I was working on the venture side, working with our hedge fund LPs. I helped launch Matrix Exchange, a fully regulated crypto exchange in Abu Dhabi, as well as a fully regulated custody business in South Dakota called Digital Custody Trust Company. So I'm sharing all of that with you because while at ChainSafe and with my background, there's something that we have noticed. Screen change, please. Thank you. There's something that we've noticed over the years. We've noticed that there's been a few different waves of blockchain adoption. And this is what I'm pretty much here to talk with you about and to share kind of where I think we're going and what ChainSafe's doing about it. So in the first wave, we were looking at financial ownership. This is all Bitcoin and altcoins related to Bitcoin, and looking at the market crash of not only 2008, but of all of the market crashes over the 100 years before that. And people coming together and saying, we want more financial freedom, we want peer-to-peer transactions, and we don't want banks gambling with our money, and we want to have some responsibility of our own. That took place from when the Bitcoin white paper came out in 2008, and through 2008 and 2016, we had pretty good adoption. We now have over 300 million people who own crypto today, and we've had over 1 billion people worldwide using crypto exchanges, which is impressive, but it's not enough. We then had a second wave that had to do with Ethereum and smart contracts, which was all about ownership and infrastructure. So how do we move beyond just cash or crypto, and how do we move into data ownership? So Ethereum, thankfully, also helped us move forward with decentralization of our data, not just our money. We now have over 2.4 million people actively using smart contracts on a daily basis, and an estimated 250,000 people trading NFTs each month on OpenSea alone. But it's still not enough. So what is this third wave all about? The third wave of blockchain adoption is really about gaming and user experiences. We've finally gotten to a place where security is getting better, where our wallets are getting better, where the user experience is not so glitchy and buggy and only for a crypto native. And that's what I'm here to really talk with you about right now. Right now, we have 50% of smart contract daily active users are using gaming dApps. And in just Q1 alone of this year, over $739 million USD were invested into Web3 gaming. We also know that in March of this year, Sony filed a patent to allow transfers of NFTs across games and consoles. I think this is pretty exciting and is a huge signal that gaming is the future of blockchain for at least the next coming years when it comes to adoption. So what does ChainSafe have to do with this? ChainSafe has something called Web3 Unity. It's a fully open source gaming SDK that helps you get on from Web 2 gaming to Web 3 gaming. So what does that mean in practice? We're a full end-to-end developer toolkit, essentially, that helps studios further activate dedicated communities of players. Developers can create engaging, self-sustaining gaming experiences where they're not totally stuck with just publishers and they can activate on their own. And gamers can have more ownership. ChainSafe Gaming, our Web3 Unity SDK, is used by over 150 games today. Some of those games include Untitled, Pillar, also includes Burbs, Toshimon, and more. And I'd like to show you what that kind of looks like in practice. So if we can play the demo, please. All right. So normally there's like a fun sound going on in the background, but what you're going to see playing right now is a game demo that our team has created. It's built on the Kronos testnet. It's utilizing chain-safe storage, which connects directly to IPFS. You're also going to see the deployment of read and write contracts. That's ERC20, ERC721, and ERC1155 are all being deployed within this demo. You're also going to see a wallet connect. All right, so that was Web3 Unity. Again, fully open source, gaming SDK, totally free to use. Look up Web3 Unity if you want to find out more. Oh, skipped a page. I think there's a couple of slides that aren't loading, and that's okay. What those slides would have said, and I'll just like refresh what I had mentioned. Web3 Unity is completely free, it's completely open source. It helps Web2 games get onto Web3. If teams are looking for more, if they want help with smart contract deployment, for example, we work with a team called Pillar that needs help with its smart contracts and batching its transactions on-chain every day so that their gamers can see a scoreboard. That's something that we do, as well as minor and major customizations, tech support, and maintenance. We're looking for the next few teams to partner with. We're also open to joint ventures. If you want to talk with me more, here's my Telegram. It's LizTK, and I'd love to chat about ChainSafe and ChainSafe gaming. Thank you very much.
Thank you very much, Liz. Okay, so now thank you very much, Liz, for the presentation from ChainSafe. Next up, we have Scott Shi from ZetaBlock. All right, let's give a warm round of applause to Scott from ZetaBlock. Thank you.
Hey guys, first time in Hong Kong actually, travel all the way along from San Francisco. I'm co-founder and CTO of ZetaBlock. Today I'm going to talk about how I think is a weak recipe to get the next billion users and what's actually seriously underfunded. A little bit about myself and our team. Chi and I co-founded ZetaBlock a year ago, like early 2022. She got her PhD degree from Berkeley, and she worked at lead PM in Databricks. Myself, I lead the engineering team, safety data engineering team at Uber. So grew the team from myself to 200 full-time employees. And also I was the engineering committee chair for a year and a half, basically supervised all the major engineering design at Uber. We also have Rafael run the head of operation here. Before that, he was the head of data at Polygon team. So basically in charge of all the data analyst, data engineering, and BI part. From engineering side, we have Rohit join us, and then he worked as a principal. Prior to ZetaBlock, he worked as principal at Confluent, basically built a next generation Kafka team. So we actually haven't public beta yet, but we actually got a lot of top projects as our paid customer, including like Polygon repo, Chainlink, Circle, etc. So it's all from, like we spend zero money on marketing, it's all from word of mouth. So what problem we are solving? Like we only have less than 1 year old. What problem we are solving? Like, I think the next billion user to Web3 requires a much better data infra. The first time I look at Web3 ecosystem, I found that it's very attracting and very interesting because the whole Web3 ecosystem is like a technical to C company, like similar to what Facebook, like similar to what Uber, like Amazon or TikTok. But in these companies, you have 15% of engineering resources work on infra, like data infra alone. Like Uber has 600 dedicated data infra engineers, just build data infra, and overall like only 4,000 engineers. So because of this, it's actually make sure all the product team can build their application easily. Just focus on business logic. You don't need to focus on, for example, get the data, process the data, and then backfill the data. That's all very tedious work. But existing Web3 data infra is we're probably going to see 4 biggest pain points in next few slides. Existing Web3 data infra is actually in a very poor state. It means that application and layer 1 and layer 2 chains, they cannot easily convert data into insights. Like for most common use case, after I interviewed more than a few thousand enterprise customer, layer 1, layer 2 chains, I summarize. The first is that you want to provide better user experience. You don't need to actually provide superstar user experience. You just want to show portfolio history, transaction history. That's actually not easily available. So you saw a lot of DeFi don't show the portfolio history, like what Robinhood provided. The second thing is that you want to use the data infra to actually acquire more users, because all the data is on-chain. Like this is the most part. As a startup founder, as a data infra company, I like that all the data is open, the data is flow, data is unstoppable. All this data is on-chain. So you can actually look at who is the most credible, who is the most valuable user, and acquire these users through marketing directly. The third part is that you want to actually get long-term value per customer, because think about TikTok. The whole application is built on top of recommendation. You actually need a very solid data infra. You cannot have garbage in, garbage out. Then you can build a machine learning model, personalized machine learning model, recommended the right short clip to the right user. Without this data infra, it's just impossible to build it. The last part is that you want to stay ahead of computation. This is actually very common for L1 and L2 chains. They want to understand what's the daily active user, what's the user going to look like in other chains, and see what's the emerging traffic. One big chain customer we work with is they want to build actually an app store user experience, because they don't even know what app is actually trending and what app is actually very popular and how users use the app on the chain level. So, but what are the most challenging part in this part? I think I summarized into 4 components. First is that you have the data source very fragmented. Let's take an NFT transaction. So again, throughout this computation, this presentation, I'm going to use the simplest example, because even the simplest business use case is very hard if you build it yourself. Let's say we just want to show an NFT transaction history. To take Bored Ape Yacht Club as example, you have image on IPFS. You're going to have price data from crypto exchange. You want to notice how much actually you pay per token purchase, OpenSea or other platform. You also have token metadata on IPFS and collection metadata on IPFS. You have all the transaction data in Ethereum mainnet. The data is fragmented than ever. Like in a Web2 company, you can put all this data in a DB and don't worry about it. But in Web3, you actually get data from 3 or 4 different sources. The second most important issue is the data access pattern are very limited. In existing landscape of the Web3 data infra, you saw a lot of data warehouse solution like analytic. You can get historical data. For example, I just want to show my portfolio history for ERC20 holding or ERC721 holding. I can get the data, historical data from analytic, but that don't provide me real-time data. If I purchase an NFT token right now, I cannot use this data warehouse solution to get the notification. I need to use a different data source. And then all this data need to be indexed, because you don't want your user waiting for 15 seconds to show their portfolio history. So you actually need to index all this, which is a very pain point. Like it's not user-friendly at all. And the third point is that chain data is not usable. I'm going to expand more about that part. The last part is data quality is very poor. Okay, let's actually expand each part. Like the first part is data source is very fragmented. If you look at the data source for the Web3 data, you can see different data source. For example, blockchain layer, you have different chains. You have interaction layer from node provider, and then API access. You have data layer. You have some metadata from DB, IPFS data, social media data, price data. And you have indexing layer and analytic layer. You want to get the data. Still, let's take the most simple example. You want to show your NFT transaction history or ERC20 transaction history. So first, you need to get wallet information. And second, you can get all the transaction history from API service or indexing service. Third, you need to enrich this data with some user metadata, because you want to show what collections users are purchasing. And then last part, you need to enrich with price data. It's very silo. It's a sequential call. It's easily converted to more than 100 RPC. and then it's going to take 5 seconds minimum. Let's look at the second problem. Let's look at the second most challenging problem. Okay, sorry, I need to actually go back a little bit. Okay, so now the existing developer forced to make a choice between use the data warehouse solution with an API indexing solution. Data warehouse solution like Duo Analytics or other data warehouse solution. In theory, use data warehouse solution proves that you can run any complex query, you can convert your business logic into query and get the data. But it means that it's going to be very high latency. It takes a few minutes to few hours to run the query, and you cannot embed this into your application because it don't support concurrency more than 10. And it's also very expensive. It takes, underlying for these vendors, it takes 10 cents to $1 to run one query. No matter if they decide to charge you or not charge you, it's not a sustainable model if you just want to link this to your website. And additionally, you have very poor data refresh from a few minutes to a few days, and you don't have streaming support. It's not necessary to have streaming support. If the data is 1 day old, why do you need streaming? But for the indexing on API solution, you can bypass all this concurrency, low latency, cheaper issue, and also you get much fresh data. You can hook with your website, but you basically have no business logic. You actually need to do it yourself to enrich with business logic. And it's actually deadly slow. If you join 2 tables, you're going to have your user hung there, not refresh any page. The third problem for this blockchain data is that the third problem for the chain data is that it's not usable. If you look at this, I think it's 2 problems. First is that the data is not abstractioned. Means that if you look at raw data, it's very hard to understand what's actually going on. You need to decode the data, and decoding has lots of tedious details, like proxy contract, a very, very complex tuple data structure, etc. And additionally, the second problem for this is that you cannot convert business logic easily to the actual insights, to SQL and data. So in this case, the right side, if you can see, it's just a SQL trying to figure out how many transfers per day. In this case, you actually need to have a better understanding which table to use and convert to SQL and get the data. Okay, the last part, data quality. No matter it's a transaction-based chain, like Bitcoin, like a transaction-based chain or account-based chain, even if you miss one single transaction, you basically get completely wrong asset data. For example, I just want to see my ERC20 balance. I want to see my ERC721 balance. Even if you miss one transaction, you're going to be completely screwed up for your users. So in this case, the data quality is actually, if you don't take a look at it, don't take care of it, it's going to become bad and bad. Like I call it like data swarm instead of data lake. So how Zetablock can help in this case? First is that we build an abstraction layer on top of this fragmented data stack. So instead of interact with 10 plus, 15 plus, 50 plus, or 100 plus data source, you can just call Zetablock as a one abstraction layer and gather all the data, build together. We do have a demo use case for this. You can follow up and check the demo on YouTube in this case. And then basically you can customize your API, meet your business logic, and then serve your customer directly into the website. The second part is that how do we address the data access pattern issue? In this case, I'm waiting for the next slides. Okay, how do you access the data access issue? In this case, we provide meaningful query, but you also can get the query within low latency. Instead of waiting for 15 minutes, you get a query result from Duo or other data warehouse solution. You can just process on Zetablock and get the data directly hooked with your website and get the data with 10 milliseconds, even though it's very complex query. So in this case, you can use it directly as a single backend. The third issue, which address it also differently, is that we actually build abstraction layer on top of Zetablock. So instead of you looking at the raw data layer, we enrich the data with metadata. We build abstraction table, so you can look at DeFi, NFT directly. Human readable data instead of like very tedious raw data. Like have no idea what's the hex data about. The last part is data quality. I think one of the issues we talk with customers that they often think this is actually a DIY problem. They can just scan through hundreds of thousands of different protocols, looking for 10 protocols they are looking for, and then build the table themselves. But it's actually an understatement how hard it is. For example, for each table here, we first need to build a data modeling for each table. Let's say Ethereum logs table or Ethereum events table. We first need to actually have data modeling. We need to backfill the data. We need to insert data in real time. We need to maintain a schema in the Ethereum schema involve like every 6 to 9 months. And then for maintenance part, you need to actually make sure the data is always on, like the data is always available. You need alerting, like this is actually a snapshot of alerting we built internally. So we add a lot of data quality check. If the data quality is falling apart, we're gonna alerting and auto recovery. And you need to repeat this for every single table. How many tables you need if you build a user application? From our past experience, you need at least 50 table to 200 table. And you need to repeat this process every single table. So that's why it's not worth it and not just build it yourself. Okay, so yeah, I couldn't resist to add this slide. I feel like the whole Web3 ecosystem, you have a lot of super cool apps, you have a lot of super cool L1, L2 chains, but it's not ready for the next billion users. If you don't build a TikTok, you're going to be replaced by TikTok, right? If you don't have a data platform, you're going to be replaced by someone who has a better data platform and build a machine learning recommendation system on top of it. So that's we're still working towards this. We haven't solved all the problem, but we want to make sure every single cool application, protocol, L1, L2 chains has a smooth ride for get the next billion users. So yeah, sorry, I don't post my Twitter, my personal Twitter, but you can follow up our Twitter and the website. You can also message me at scott.sh@zetabox.com.
Okay. Thank you very much, Scott. I see a lot of people taking pictures. Interesting, great presentation. We have two more amazing presentations, just two more coming up. So next up is Darren Guo from REAP, R-E-A-P. Darren, the floor is yours.
Hey. All right. Thank you, everyone. My name is Darren, and I am one of the co-founders for REAP. And today, I want to talk about enabling access and real-world use cases for Web3. To quickly introduce ourselves, REAP is a financial services platform that enables access and connectivity for businesses, global businesses of all shapes and sizes, right? We are combining our corporate credit card with spend management software to help businesses digitize their finances, allow them to apply spend controls, and then essentially just streamline their financial planning and management process. And I think especially in the Web3 world where there is more stakeholders in the regulations, tax authorities, having clean financial data becomes very important to drive growth in the next stage of Web3. I think for us, we've had the pleasure and privilege of working with a wide variety of different Web3 projects across different stages. So everything from upstarts like Radix to Lithium to more established players like Amber and Animoca. We want to take a lot of those learnings and insights and bring them to the next wave of Web3 projects so that they can ultimately be set up for success from day one. All right. What the fuck? Sorry, 1 second. Okay. Now, as you guys may have read in the State of Crypto report for 2023 published by A16Z, I think Web3 has a chance to become the next computing platform where innovative internet-enabled businesses are built upon. The underlying design and architecture of Web3 fundamentally empowers user data, it empowers users to be able to switch platforms, and ultimately cultivates more growth within the internet-enabled business sort of ecosystem. Similar to how Web 1 and Web 2 fundamentally changed and revolutionized the way that information and publishing is done, Web 3 can change the way that businesses interact with their customers, with their partners, and vendors over time. But the issue is, all of this sounds very good theoretically, right? But how do we actually bring more developers and bring more customers into the Web3 ecosystem? We have to do this through real-world use cases to create this positive feedback loop around growth, around product, and around innovation. We want to be able to create like a ChatGPT moment so that the underlying technology is abstracted and not as much of a focus, but for customers, the focus is instead on the value and benefits associated with the Web3 ecosystem. Now, since we started in the Web 2 side, we are fundamentally sort of better suited to be able to capture some of these real-world use cases. So we work with trading companies that want to enable more global trade. Obviously, being from Hong Kong or the US, this becomes less of a problem because we have access to these goods and services. But if you apply the same level of thinking to places like Africa, to LATAM, they don't have as much of a stable currency or payment methods that enables them to get access to the same type of goods and services that we are able to get access to. Family offices, investors, businesses are already thinking about managing their treasury in a more diversified way, especially given everything that's happened in the banking issues in the last 3 or 4 months. Foreign exchange hedging is a big use case that we see as well, where if you're interacting with a LATAM customer, your margins and revenue can fluctuate 30, 40% on a monthly basis because of the volatility of the underlying currencies. And then finally, even within traditional businesses where you would think that they would have access to banking infrastructure, international payments, there are certain industries around travel, gaming, that fundamentally are more high risk in the eyes of banks, so they don't actually necessarily have alternative solutions that they can work with. And this is where I think REAP also has a sort of a role to play in providing alternative solutions for those types of industries as well. So now that we have established the underlying infrastructure being very beneficial to solve real-world problems, what is the next step, right? And I think for us, what we see is that the accessibility to fairly basic fiat financial products, bank accounts, corporate credit cards, is still fairly inaccessible in the eyes of for Web3 generally, right? Because even if you are a crypto native business where your entire treasury is done in tokens and in crypto, how do you pay for Zoom? How do you pay for conference tickets? How do you pay for lunch? And these are the things that we want to be able to fundamentally solve so that there's more growth within the Web3 side. The bigger problem that we've seen also is as these projects start to scale to the size of an Amber, a lot of the way that they manage their finances is very, very manual. So they wouldn't be able to have access to things like virtual cards, spend controls, real-time reporting and things of that nature to really streamline the way that they manage their operations and financial planning process, especially in an environment where the demand for cleaner financial data in the eyes of investors, in the eyes of regulators, become more important, and there's needs to be more financial controls to be able to inhibit and prevent bad behavior. We want to be sort of the standardized platform that allows every single crypto project to be sort of more legitimate so that the value and innovation that they're creating has more long-term sustainability and can continue to provide value to the real-world use cases that we've seen be effective in solving for the Web3 side. So as we look to the future, right, and our focus is to continue providing more real-world applications that increases the connectivity between Web 2 and Web 3. And I think it starts with a fully compliant multi-currency on and off process, the ability to actually tie your treasury to bills that you fundamentally have to pay for, and in the future, allow platforms to not just get connectivity through us, but allow them to provide the connectivity to their users. So things like white labeled cards, an API and payout product that allows them to sort of be able to pay in crypto or fiat. These are all things that we're thinking about to be able to continue driving that connectivity between the Web 2 and the Web 3 side. I think to conclude, we are extremely bullish and excited about the future of finance. And I think by focusing on real world applications, we can bring more developers and consumers into the Web3 ecosystem and hopefully foster a more global economy and a more prosperous and sustainable future for everyone involved. Thank you.
Thank you very much. Thanks, Darren. I sure would like to get my hand on that REAP Visa credit card that I saw on the screen. Okay, so we have our last a presentation for our open mic session. So I'd like to welcome Rudy Lu from Stone to be on the stage. So everybody, let's give a warm round of applause to Rudy.
Hello? Hello? Hi everyone, yeah, good morning. And my name is Rudy, the APAC partner from Instones. And Instones is the world-leading infrastructure service provider. And you know, Ethereum just finished its Shanghai upgrade yesterday. And today, here I want to share something about Ethereum Shanghai upgrade. Why Shanghai upgrade will impact the whole staking service provider and infrastructure service provider industry. Oh, sorry. Yeah, just some brief introduction of ourselves. Instones was founded in 2018 and aimed to be the all-in-one stop for the Web3 infrastructure service. And now we have already provided the infrastructure service for over 80 blockchain protocols, and we have been operating over 20,000 validator nodes on behalf of our institutional customers and end users. Yeah. And an overview of the industry. So, you know, we serve the POS protocols. And as we started in 2018, actually the majority of the POS protocols at that time adopt the DPoS mechanism. And DPoS mechanism is good. It's very efficient. But you know, there is a limited validator number on those DPoS protocols. Usually, there are just around 20 validators. And all of those 20 validators need to have a strong connection with each other to make sure the network can run smoothly. Even a single weak connection between two validators will lead to the network unstable, or even worse, the network downtime. And as the technology evolves, we start to see the POS protocols with 50 validators, 100 validators, 200, 500, and now we see there are 500,000 validators on Ethereum. That's amazing. And you know, a large number of the validator set can make the network more secure, more stable, and more robust. Next page. Yeah. And looking back to 2018, the most powerful POS chains at that time was US and Tron. And the US, there are only 21 validators, and Tron, there are only 27 validators, and there is no penalties for any validator offline. And in 2019, Cosmos launched. And Cosmos has 100 validators at that time. And also it increased its validator number to 175 now. And also Cosmos introduced the slashing mechanism. And 2020, Ethereum launched its POS layer, and now it has more than 500,000 validators on Ethereum. And also it has a strict slashing mechanism. Even a small amount of validators downtime can lead to directly losing the stake. Okay. And actually, it's not only the thing happening on Ethereum. Actually, it's a trend happening across all of the POS chains. For instance, Harmony, there are only 320 validator nodes on Harmony when it started. And now there are more than 900 validators on Harmony. And also Near, there are only 100 validators on Near when it started. And now it's introducing additional 200 to 400 chunk-owning producers into its network. And chunk-owning producers is a special kind of Near network, special kind of validators on Near network. And Instones has also collaborated with these two networks to provide the infrastructure support during this transition to more validators. Okay, so we have shared this trend happening across all of the POS protocols. There are more and more validators set up on those POS networks. And then let's talk about the Ethereum Shanghai upgrade. Yeah. Yeah, why is it important? So before Ethereum Shanghai upgrade, actually there are many institutions and end users that's not participate in this ETH staking because the lack of the liquidity. So that's one of the most primary concerns. And after Ethereum Shanghai upgrade, it enables withdrawals. Users can withdraw their deposit at any time. And so it reduces the risk of liquidity, and we can expect a large batch of validators, new validators, coming into this network. I know someone would say, oh, come on, there are already 500,000 validators on this network. How it can be more? So actually, even with so many validators on the network, the staking ratio of Ethereum is relatively lower than other POS networks. Here is a comparison of the staking ratio between Ethereum network and other POS networks. You can see currently the staking ratio of Ethereum is around 15%, but the staking ratio of other POS network can be 50%, 70%, or even 90%. So there is a huge potential of more validators. Okay. And how it will impact the service providers. So service providers need to prepare to handle the huge batch of the validators coming. They need to handle the large batch of validators coming from the institutional clients and also the large stake of fractional stake like 0.1 ETH or 1 ETH. So it represents the challenging for both delegator side and validator side. And here is a chart for the Ethereum validator count increasing over time. Yeah, and so frankly speaking, Ethereum validator actually is very hard to set up or maintain because the provider not only should handle the validator side, but it also need to handle the execution layer, which is previously named as Ethereum 1, and also the consensus layer, which is previously named as Ethereum 2. They need to both handle Ethereum 1 and Ethereum 2, and also the MEV things. And since Ethereum is really decentralized, private providers need to set up the nodes as distributed as their customer needs. So it's really complicated. And how we should adapt this, how InfStones adapt this. So at InfStones, we have already supported a large batch of validator setup up to 1,000 validators at a time. We support users to launch 1,000 validators at a time with a single click. Just click one single button and with a single transaction. Yeah. And meanwhile, we also support the large batch of validators on staking. So user can just unstake many validators at any time they want without any customer service. They can just click a single button or send a single API request. And also, we are continuously helping to foster the decentralization. Our company's vision is to support decentralization, and we are doing this by giving our customers the freedom of choices. Because as the infrastructure provider, we only provide the infrastructure, the management, alerting, to assist our individual customers or users to operate their own nodes. So all of those nodes set up on InfStones are entirely belong to our users, not us, not the infrastructure provider. And also, we are fully non-custodial, which means the customers can withdraw their fund or deposit at any time. And we offer the full flexibility of the technical specifications, so customers can customize their staking operations according to their specific needs. And the most important thing is not your keys, not the coins, right? So we really understand the importance of the non-custodial. And regarding staking, actually there are two important things. One is the key of the node. The other thing is the key of your fund. So for the first thing, as I said, all of the nodes set up on InfStone platform belongs to our users, not us. And for the fund, we are fully non-custodial from day one, and all of our users can unstake their deposit anytime. And there will be a big announcement soon. We will also introduce another option named Bring Your Own Node. It means our users can bring their own existing node into the Infosys platform and enjoy the full tool set provided by Infosys platform. And also, meanwhile, all of the nodes set up on Infosys platform are fully monitored and maintained effectively and efficiently. So that gives users peace in mind to focus on what they really matters. All right, and that's all of my today's presentation. If you want to stake ETH or stake on other POS protocol, just contact us on Infosys platform, or you can just log in and stake. There is a really amazing UI interface, really easy to use. Yeah, and thank you all. Thank you.
Thank you, Rudy. Okay, that concludes this morning's event. Thank you again for attending the HashKey Capital Conference at the Web3 Festival. 这个就是我们今天上午 HashKey Capital 的分会场就结束了。I really want to thank the organizer Wenxiang Blockchain Labs as well as HashKey Group for giving us the opportunity to do this. And most importantly, I want to thank the entire team from HashKey Capital who putting together this. Siya, where are you? Especially to Siya, our executive directors of branding and marketing. A huge round of applause for Siya and the entire team. Okay, thank you very much for spending time with us. And there are more events and panels this afternoon and tomorrow as well. So enjoy the rest of the day and tomorrow. Thank you.